Well, good morning, everybody. It's so nice to see so many of you here for the Global Trade Facilitation Summit, second edition of this event. So nice to have so many of you here in the audience, and there's many more actually coming in right now, which is really, really wonderful. And so happy to have so many people joining us online from all corners of the world. So we're going to get underway, so let's get underway here today in Dubai Chambers. And I'm going to ask our welcome address from Mohammed bin Sulaiman, the Director of Business Relations of Dubai Chambers. So Mohammed, if you will join on stage, that would be great. Thank you, Mohammed.
السلام عليكم ورحمة الله. Ladies and gentlemen, a very good morning to you all, and thank you for joining us today in Dubai Chambers. We're very delighted to host the Global Trade Facilitation Summit 2023, themed Trade Transformation and Technology. The summit brings together the global trade facilitation programs of the multilateral development banks and provides a unique opportunity for banks, trade professionals, importers, exporters, lawyers, and logistic providers to gain insights into trends, opportunities, and most importantly, the challenges impacting the global trade and finance world. The transformation of global trade due to the pandemic, supply chain disruptions, geopolitical developments, raising interest rates, and inflation cannot be understated. The role of the multilateral development banks in underpinning secure international trade finance cannot be overstated. The MDBs have become a central and essential cog in keeping supply chains in motion through the provision of trade finance supports when and wherever needed. In addition, the MDBs continue to take on payment risks and provide finance into countries where commercial banks are pulling back or not willing to enter. Through the innovative structures deployed by the MDBs, exporters are enabled to securely ship goods to buyers in countries that otherwise wouldn't be feasible. You will see over the next 2 days that the MDBs have ensured continuity of essential imports into countries that are financially challenged and in need of their specific supports. The work is commendable and must be supported, encouraged, and enlarged. Dubai Chambers itself is also transforming to further propel investment and facilitate the expansion of trade, and in doing so, strengthening Dubai's position as a leading global trade hub. So under the transformation of Dubai Chambers, now 3 chambers operate under the umbrella of Dubai Chambers: Dubai Chamber of Commerce, Dubai International Chambers, and last but not least, the Dubai Chamber of Digital Economy, and each chamber has its own individual brand, strategy, and specialized approach to support businesses, trade, and investment throughout. The Dubai International Chamber opened 4 new international offices last year, growing its international network to 15 offices, and the target to have 50 different offices operating overseas. This pace of expansion will definitely continue to increase. Similar to the multilateral development banks here today, we see the power and value of local representation on the ground in key strategic markets. Dubai Chambers will continue bringing events like the GTFS into Dubai in the future. So once again, welcome to Dubai Chambers. Wish you all the best with the significant work ahead. I saw a very crowded program and agenda. Vincent has put some good work together, so all the best with this. One observation to share from the first edition of the summit last year, also hosted in Dubai Chambers in March 2022, it was truly wonderful to see representatives from so many different countries engage and so actively during the summit. There was a number of debate, dialogue, agreement, and in some occasions disagreement that was all undertaken by the participants, always with respect and friendship, the way it should be. We believe we can always disagree for the benefit of the good. The last summit was truly enlightening to have here in Dubai Chambers. So we wish you all the best in your work ahead and the coming 2 days. And once again, thank you for coming, for joining us in Dubai Chambers, for visiting Dubai, United Arab Emirates. Thank you.
Thank you very much, Mohammed. That really got us off to a great start and really set the scene about what we're going to do over the next 2 days. And the ICC itself, the International Chamber of Commerce, following on the theme started by Mohammed, is all about trade facilitation. The ICC itself, as you know, and bear with me just for 1 minute because I think it's really important. The ICC is about 100 years old. I'm just 99, nearly 100. And the ICC, when it was founded 100 years ago, just after the First World War, at a challenging time in the world, a small group of men and women came together with the idea that in times of unpredictability and challenge, trade is the way forward. So this little group, when they started, before they became known as the ICC, they were known as the Merchants of Peace. They had a little nickname called the Merchants of Peace, because they strove to create rules, regulations, and standards that would actually facilitate the understanding of trade and remove barriers to trade. So I can say that the ICC has been successful over the years, successful to a large degree. But we're not there yet, and we have to keep the momentum going. So that's why this event, with so many people, so many different countries, we have people here from Azerbaijan and Armenia. We have people here from Iran and United States, Afghanistan, Pakistan. We have people here even from England and Ireland, you know, and we're best friends, as you all know. But we are all best friends, and we're all working together with the same objective, sustaining, and as Mohammed said, promoting and advancing trade. Because trade brings growth, trade brings development, and being an Irish guy growing up in Ireland in the troubled years, I know that when business starts happening, it brings peace and prosperity. Really, it really does. So that's what we're all about here today. And as Mohammed said, in our last event last year, it was quite unique, because you have so many conferences where there's very nice panels and very nice discussion. But as I said, last year there was quite a bit of, you know, debate and argument, but all with respect and with a lot of humor and with a lot of fun. And that's what it's all about. So as we go through the days, we have people joining us virtually, and of course we have many people in the auditorium, and they're still actually coming in, which is actually great. But just a few things to make clear. We got feedback from our event last year, and people said they would like a little bit more time to network, so our coffee breaks are a little bit longer. But as you know, I'm not a moderator. I want people to be on time, okay? But our coffee breaks are a little bit longer. We had a social event for social networking last night, and we have the gala dinner, which you're all invited to on Thursday evening. So really, we have lots of time available for talking, meetings, whatever. So I want our engagement in the room, because the work we do in this room is the root work that's going to actually make a difference. So I was asked about the Wi-Fi. The Wi-Fi is open here in Dubai Chamber. The program is found on the ICC website, but outside you'll see the QR codes on the tables. Just scan the QR code, you get immediate access to the program. And should the program change, it's updated in real time, so you're always on time and aware. So again, it's so wonderful to see so many of you here, so many friends from different corners of the world. So we're going to get underway. We're going to get underway with the proceedings, and we're moving forward to a keynote, and it's looking at sustaining the pace of trade transformation from our gold sponsor, National Bank of Fujairah. So Adnan Anwar, Deputy CEO, National Bank of Fujairah, I'll be really delighted if you can join me on stage and provide your keynote. And NBF have been a long-time supporter of the ICC, goes back a long time, and we greatly appreciate this. Adnan.
Mr. Mohammed bin Suleiman, distinguished guests, ladies and gentlemen, a very good morning to all of you. Good morning. Well, what I have heard already from Mohammed and yourself, it's great already. I think I will just be reflecting a little more on that. But today I'm covering in place of our CEO, Vince Cook, who couldn't be with us because of last moment ill health. So I will try to do justice. So let me start on behalf of NBF, congratulating ICC UAE for playing a key role in the development of Dubai and the UAE in general, but specifically in the trade finance field. It has been fantastic achievement, what you guys have been doing together. And this conference and evolution of that is a testament of the efforts and the contributions being made. It is our honor to be there as the gold sponsor for the event. And our association with ICC, as Win said, goes back to 2011 when it all started. So it's a prestige and immense pleasure to be here. Being a bank, let us reflect a bit on the economic backdrop, what has been happening and how it impacts the trade finance. So we believe that historians may come to regard 2022 as a hinge in history, marking the end of one era and the beginning of another. As the year started with positive news that the COVID-19 perhaps is getting under control, and the free travel meant that we can meet each other and probably trade can start more freely. However, February 2022 marked the news of Russian invasion of Ukraine and subsequent sanctions, supply disruptions, what events, they created a new set of challenges and hampered the flow of trade a little bit. At the same time, the rise in interest rates in all the central banks' efforts and their determination to combat inflation also meant that different businesses had to grapple and they weighed on the economic activity. The global growth is projected to fall from an estimated 3.4% in 2022 to 2.9% in 2023. And then it will bounce back to around 3% as per the estimates. While global inflation is expected to come somewhat under control from 8.8% going down to 6.6% next year and then 4%, but the recent events in the US with regard to Silicon Valley banks and signature banks, we are yet to see how they will unravel. The lockdown in China dampened growth a little bit in 2022, and the continuing trade wars also had their share of impact on the global trade. But the recent opening of China is a good sign, and hopefully it will help spur the trade finance activities. Now, coming back to our part of the world, the UAE, as the fear of the world slipping into a recession grows, the UAE economy stood resilient and strong as evident from the upward revisions in the economic forecast for UAE by IMF. In the latest report the IMF recently released, the UAE's GDP is estimated to grow at 5.1% compared to previous forecast of 4.2%. And meanwhile, the forecast for 2023 has been upgraded from 4.2% from 3.8% previously. From the foreign investment perspective, Dubai alone attracted inflows of around 14 million dirhams in the first half of last year, which also created more than 15,000 new jobs and employment. So, which is a great sign. Now, going by the theme of transformation, what we are seeing the biggest opportunities lie perhaps in the areas of trade flows themselves, which are changing, and digitalization. And when I look at that, UAE has been leading the way. So the free trade agreements, CEPA, they are with some already signed with some of the countries, are creating new opportunities and growth already. When it comes to banks, a number of automations and digitalizations are happening on the process side, how to make customer experience and journey different and accelerate the growth. So the number of technologies we are seeing coming into the play, the machine learning, artificial intelligence, OCR for data capturing, is all getting implemented. We as NBF are proud to be the first bank in the region using AI-based platform document checking under LC activities. What does it mean? It means we are able to process large volumes much faster for our customers. It also means that customers no longer have to wait, give physical documents before we can start checking. They can also share digitally scanned copies, and we can do these sort of pre-checks. And all in all, it can help reducing almost up to a week in the processing cycle, making the finance and cash flows, liquidity available to clients faster and help in promoting the trade finance activity. Apart from that, despite the global slowdown in the activity, the 2022 ended very strong for us. Our results showed strong growth of 25% in operating income and almost 195% growth in net profit. This reflects impressive local economic recovery in the face of uncertain global environment. So I'll give you some facts about NBF so you can appreciate what we have been doing. So NBF has long played an active role in the development and promotion of local and international trade. More than 60–70% of our business has anchor and linkage to trade finance. And NBF boasts an extensive network of correspondent banks locally and internationally, which allows us to serve as one-stop shop for our clients, be it export side or the import side. NBF also takes pride that we take an advisory role when clients come, how to structure particularly the commodity financing space and promoting commodity trading in the region. And the niches where we operate include energy, marine, precious metal, and gold. And some of these have become the largest dominant trade finance sector in the country after oil. Today's agenda for the conference is well diversified, covering a wide range of topics: sustainability in trade, supply chain, digital challenge. And I wish you all find them relevant and learn from these sessions, and I look forward to these sessions. In closing, let me congratulate ICC UAE once again for its role in furthering the development of trade in the country. Despite the short-term challenges, the future continues to be bright for the UAE, and we as a bank look forward to working with all of you to raise its profile as a global trading and business hub. Thank you and enjoy the conference. Thank you.
Well, Adnan, thank you for a wonderful keynote. And NBF may not be the biggest bank in the UAE, but when it comes to trade, you have a really big footprint, and you're really making your mark. And we have a lot to learn from National Bank of Fujairah. Just to let you know, our virtual participants can send in questions on the chat, and actually Habib is relaying the questions then to me in WhatsApp. So it's questions and comments, and we have one comment so far, and it says the address of Mohammed bin Salman really set the scene for a wonderful conference. So well done, Mohammed. I thought my words were pretty good too, but no one said anything about me, so I'm not really happy about that. So if you're out there, you got to say something good about me as well. Okay. So having set the scene, we're going to get a little bit more granular, and we're going to get a little bit more focused on trade and trade through the UAE, into UAE, out of UAE, cross through UAE as a connector, as a trade facilitation gateway. So I'm really pleased to introduce to you our next speaker, who will speak on the UAE as a trade facilitation gateway, connecting the trade world. And this is Nadia Abdulaziz. Nadia, if you can join me on stage. And Nadia is a board member of ICC UAE. Among other things, she's also chair of the ICC UAE Trade Facilitation Commission, and she holds so many more important roles. I just don't have time to introduce them all. So Nadia, over to you.
Assalamu alaikum wa rahmatullahi wa barakatuh. This is something that you're always going to hear within this region, which means peace be upon you, and may God bless you more and more. My name is Nadia, and I will be speaking a little bit, shedding a bit of light on business opportunities, business sectors in the UAE And before I start, I'd like to thank all of you, the Chamber team, Mohammed bin Sulaiman, Mr. Khalid, business group heads, and everybody who's flown in to come to this warm city. Thank you for being here with us, and thank you for joining us at the ICC Global Trade Summit for the second time, or maybe more. We'll start off initially. I will cover some facts on the UAE, safety, business opportunities, growing sectors, and promising sectors when I wrap up, and then authorities support and government strategies that support our industry. So basically, the UAE got incorporated in 1971, more specifically 2nd of December 1971, with our late ruler, His Highness Sheikh Zayed bin Sultan Al Nahyan, may he rest in peace, the father of our existing ruler, Sheikh Mohammed bin Zayed Al Nahyan. We are composed of 7 emirates, so you might hear Sharjah, Abu Dhabi, Dubai. Don't get confused, they are part of the United Arab Emirates. And why I put our leaders' photos is not because I'm a government employee or I'm paid by the government, but because I need to emphasize the role of leadership in creating what we have right now, in creating a sustainable business, a thriving country, as mentioned, that has a lot of growth promises, and that is also because of our leaders' vision, our leaders being close to the people, open door policies, and being pro-investments and pro-supporting people within the country, not only nationals, but all nationalities. These are the rulers of the UAE, the 7 emirates. And in terms of population, in terms of being a trade hub, Dubai is the most diverse, the melting point, the trade hub for many years, of course, and that is reflected in the number of people living in the UAE, and specifically in Dubai has the highest ratio in population density. So it's around 3.49 million recently, followed by Abu Dhabi, 1.849, and Sharjah. These are the main populated cities with a lot of action going on. Of course, the capital is Abu Dhabi, where all the decisions, cabinet decisions, federal ministries, everything is taking place over there. A lot of emphasis on the oil and gas, renewable energy. And you are in a place, you are in the right place because English is spoken everywhere, even more than Arabic, which makes it easy to do business, deal with international markets. In addition to this, the literacy rate has moved from 53% to 98.1%, which you can see there is huge emphasis on capacity building, education, literacy, and empowerment of the people. As mentioned by Adnan, the IMF expected the UAE non-oil trade to grow by 4%, but right now they have expected even almost 5.1%, to be more accurate, outpacing all the neighboring countries, which also means that you are in the right place when it comes to investments, business opportunities, growth, etc. Basically, as mentioned also by Mr. Mohammed bin Sulaiman from the Chamber, we're just closing down on having 16 offices, 15 to 16 offices right now by the Dubai Chamber to facilitate trade for all the people setting up business here in the UAE, specifically Dubai. And within the next year, they are also thinking of having 13 to make up a total of 50 international offices to support all the business people, bilateral trade between countries. This is just some of the initiatives the government is taking to support you. Our port, so the government invests in soft infrastructure, hard infrastructure. When I talk soft, it is IT, technology, and when I talk hard infrastructure, the ports, the roads, the highways, the rail, etc., which I'm going to cover. We have one of the best ports in the region, which is a homegrown corporation, DP World, used to be Dubai Ports Authority, and now DP World manages 80 global port terminals across 6 continents. We have our national airlines that have become amongst the top 10 international airlines, Emirates Airlines, Etihad Airlines, and of course we do have the budget airlines, which I'm going to speak about. We are the center of having global events, MICE events, exhibitions, so the best place to showcase your products, your business within the region is definitely here. And in terms of connectivity, as mentioned, we are connected by air, sea, land, rail, and soon Hyperloop. How many airports do we have for such a small country? 10 airports, 12 ports, 0 income tax. I know a lot of you come from places where income tax is very high, corporate tax is very high. Also, VAT is kind of high, and if it's from India, even GST is very high. And recently, more GST when it comes to supply chain and logistics. So I hear the complaints that I get and the praise that we get for being a good tax haven, a tax exemption haven. So there's new legislation. You can set up your own offices in the mainland, not only in the free zone, without any issues in capital repatriation, 100% owned. And for those of you who don't know, you can set up your business via the e-platform Bashir within 15 minutes of time. So if that's done online, it's 15 minutes, and it tells you high emphasis on digital services across all government services, and this is where we're heading. 10-year golden visa for investors, entrepreneurs. We also have entrepreneurs, 5-year residency visa. Why? What are the key factors that make us what we are right now? Our government's being very proactive, pro-investments, open to investments, and having a long-term vision to empower the people across all nationalities, not only Emiratis, but all nationalities. Open economy, free economy, easy to set up your business, empowering investors, passion for excellence. We always strive to be heading everybody else or being amongst the top. And when you aim high, you will reach there if you have the right KPIs and you have the right team. And our strategic location, we are strategically located so you can reach a lot of places within the world, less than 3 to 4 hours, 1/3 of the global population, 2/3 of the global population in less than 8 hours. Our economy is moving away from being dependent on oil. So our income from oil is much less right now, 29%, versus 71% from non-oil trade. So you can see where the government is heading. We are looking at different sectors of industries, not the traditional, moving away from depending on oil. These are some of the export key sectors that we have. Of course, the metal industry is one of the important industries. We do have Emirates Aluminium, one of the largest single smelters globally. Building materials, we're an excellent place for re-exporting building materials. We've got excellent financial services, international financial market, and all of the bankers know about that, so we have an excellent banking system. A lot of the imports that we have and re-exports also are through precious metals and stones, as well as gold, defense industry, processed food, educational services, pharma industry, plastic industry, we produce and re-export, and a lot of the e-services, e-commerce, etc. I'm not going to go through every single one, but big focus also on renewable energy. Now, why Dubai? Why the United Arab Emirates? I think if you look at these global rankings by international renowned agencies, you will know why people come to the United Arab Emirates. We're the #1 in the Middle East to be a globalized country, #1 in the Arab world in doing business, 14th globally, #1 when it comes to COVID resilience. We did not shut down. Our airlines did not stop. We did not have strikes. We continued to do business. We turned a disaster into an opportunity, and we saved a lot of lives using our strategic location, using our supply chain logistic competitive advantage and the cold store warehousing facilities that we have for temperature-controlled vaccines to support 75 countries and millions, re-export millions and millions of COVID vaccines. Our business continued as usual. However, strict measures were taken, and that shows you the leadership's vision. We never had any shortages in the supermarkets. We never had panic buyings, which I was surprised because we don't produce a lot of these goods. We are an import market, but the vision of the leaders to make sure that everybody is secure, safe, everybody gets a free vaccine, including tourists who came here, and including tourists who got free hospitalization services while visiting the UAE in case they got COVID. That was a guarantee by the government. In terms of Dubai, if we take Dubai as an example, it's one of the most cosmopolitan cities. Third best cities for expats, Internation Expat City ranking. Fourth best destination for tourism, international travelers. And the #1 in the Arab world when it comes to innovation index. So there's a lot of rankings, but they don't come without a lot of hard work, without a good vision for the country, and without strategic work by the government as well as the private sector working closely hand in hand. Now, the government's focus is to make this country and city the best city in the world, the smartest city in the world. And how are we going to achieve that? Of course, if you are into the IT industry, huge emphasis on digitalization across the board to all the government services. And of course, the private sector will definitely follow. Focus on innovation, AI, secure technologies such as blockchain. So we have a strategy for blockchain long back. We have a full ministry fledged for food security. Smart services, safe, of course, for the residents, being a safe place, using 3D printing, sustainability, focus on sustainability, reduction of carbon footprint, and the use of clean, renewable energy. So if you are in such kind of businesses, you are in the right place. Big emphasis on empowering the younger generations, empowering women. If you're women into business, this is the right place. We have 50% of women on the National Council. We have ministers, and 20% by legislation of women should be on various boards across the UAE. So we are pro-women, pro-empowering the younger generation and giving them a better future. We are here to attract a lot of talent. The country is attracting a lot of coders because of its digital strategy. We have a metaverse strategy, etc. Big focus also on being cohesive, including the special needs, people with disabilities into society, giving them the right legislation to protect them when it comes to job opportunities, etc. We've just completed 50 years since the UAE has been incorporated, so we have a lot of projects by the government. Some of these projects are listed below. The 10 by 10 program, which means we want to increase our exports to 10 major promising markets across the globe. Modernization, digitalization of your permits, your visas, etc. There's a 24 billion fund to empower UAE nationals, train them, do the capacity building, and put them into this private sector. A lot of economic agreements with 8 major global markets. As mentioned, we have SIPA agreement with India, with many other countries. Free trade agreements, which you can make use of if you set up a company in the UAE. And as I mentioned, every day we bring in 100 smart coders into the country. Some of the other initiatives, as mentioned, I may be repeating some of these points: retirement visa, a 5-year residency visa, amendment of the bankruptcy law, which is in favor of business owners right now. And you have the virtual working space, which reduces your cost when you are setting a business. The Dubai Assured Stamp or UAE Assured Stamp to ensure that whatever goods are sent out have a quality and assurance once it's exported to other markets. And our new weekend is definitely in sync with the international global markets. When we talk about connectivity, we are connected by air, sea, and land. And if you're looking at connecting your business, your trade, your import, your export, or in terms of business travel, You are connected to 1/3 of the world in less than 4 hours. You are connected to 2/3 of the world in less than 8 hours using our airports. Some of our airports have been well known to be the busiest passenger airports in the world. Of course, it's a hospitable place, very welcoming, cosmopolitan atmosphere in the country, and very much pro-business investments. We had almost this year, beginning of this year, around just above 23 million visitors. This does not include the transit visitors by sea. We are connected to the ports. We have more than 100 international lines coming to our ports, whether Abu Dhabi ports, Dubai ports, DP World, or other ports amongst the Emirates. We are going to finish the rail track soon. It is almost complete. So we have the Etihad rail. We are connected across the UAE and soon across the Gulf Council countries by rail. And we have the Hyperloop, which may be also coming into Canada and India, which is faster than the airplane, a green mode of transport, connecting the capital Abu Dhabi to Dubai and maybe other cities soon in 12 minutes instead of 2 hours. Our airports are amongst the busiest airports. You are connected to 270 international destinations. We have more than 140 international airlines coming into our airports because of the open skies policies. And some of the connectivities of our national airlines, I've put the figures there. Emirates above 157. And then you have the low budget airlines, Fly Dubai, Wizz Air is something new, and Air Arabia. And then we have Abu Dhabi's national airline Etihad with 81 different international destinations. This is Emirates Airlines network. These are our main airlines. As mentioned, our airports are expected to have more than 93.3 million visitors in 2025. Good growth rates and better than the pre-COVID rates. And we have one of the busiest airports here, the Dubai International Airport. However, in terms of import-export traders, you have the Al Maktoum Airport, which is an excellent airport adjacent to the port of Jebel Ali, which is one of the busiest ports in the region. Excellent place for sea air business and for e-commerce. One way of scanning whether you're taking the goods off the port onto the airplane. And the capacity of this new Aeropolis is around 240 million passengers, 12 million tons of cargo annually. We don't boast, but we are the 3rd safest city in the world, as has been ranked in 2020, which means this is a safe, secure place for your family, for your business, even for you as an investor or potential residents. Now, the economy, it's growing. We have 1.84 trillion in terms of GDP in 2022. Expected growth for 2023 locally is 4.2%, but IMF has expected, instead of even 4%, 5.1%, looking at the autonomous growth and the diverse things that are taking place in the UAE. 30% comes from trade, 14% of our GDP is from supply chain logistics. So we deal with 220 markets. 1.3% of global trade comes from Dubai, and you are in the right place. These are some of the non-oil sectors that we are growing in: manufacturing, financial, tourism, healthcare, tourism, trade, logistics. Manufacturing is a big focus if you are into the manufacturing business. The government has huge focus on increasing manufacturing across the entire UAE. Now, in Dubai, we have at least more than 56% of the global multinational based just in this city, which means you are in the right trade hub. We have the right infrastructure to attract all of these global conglomerates. And we have more than 24 free zones within this city, but across the UAE, we have more than 40 free zones, connecting you to global markets. We use the top-notch global trade facilitation tools and custom facilitation tools, such as Authorized Economic Operator, TIR by the United Nations for multimodal transport, and ATA Carnet for temporary goods, project, cargo, etc. Now, in terms of ratings, why is the market a promising market? FDI rankings state that the UAE has the highest inflow of foreign direct trade. $66.6 billion US come into the entire MENA region, and we account to 31% of that. So we have the biggest share. Another key indicator, an increase in foreign direct inflows into the UAE, as you can see by year, it's increasing. Despite COVID, we still have good market growth when it comes to FDI, which means the market is growing. There is no slowdown. But we see what's happening in Europe, the recession, strikes, etc., geopolitical instabilities have caused a lot of disruption there. However, we are at a melting point, and we have, actually, our market is growing, including the real estate market, if people are looking at the real estate market. Despite COVID, we managed to host the largest global event in the world, the Expo 2020. Excellent event. We achieved the numbers. We even had huge numbers attending even virtually. Safe, secure event despite COVID crisis. And everything was done on time. In fact, people were asking us to extend the event. The Expo legacy continues to be on. And we have the Expo District, and all of these sustainable IT companies are based there. We are looking at green, sustainable economy. We will be hosting the United Nations' largest global event when it comes to sustainability, green, and environmentally protecting the environment. So COP28 will be hosted this year in the United Arab Emirates, which shows you where the government is being directed. There is a $500 billion US fund over a couple of years to support the environment and reduce the carbon footprint. And we do have KPIs when it comes to reduction of carbon footprint. When you are looking at events and exhibiting your products, we have some of the most busy international exhibition centers, which host a lot of the global MICE events, exhibitions, workshops. So the Dubai World Trade Center, Abu Dhabi Exhibition Center hosts a lot of the global events across the region. These are some of the free zones to be considered. We do have a lot. I've not mentioned all of them, but I've put some of their logos when it comes to logistics, import, export, manufacturing, and then you have the different free zones even for consultancy businesses, finance, etc. Big choice, but we are here to support you. So any support you need in connecting, licensing, establishing your business, as ICC team will be more than happy to assist you. Now, benefits of the free zones, of course, taxation. There's no income tax in the UAE. You can be exempted from corporate tax in certain free zones because they have long-term agreements. No capital repatriation issues. Easy one-stop shop, fast to open, different kind of offices, virtual, flexi, etc. And 100% ownership. And moving on from the free zones, if you'd like to invest in commercial property or residential property, we have some of the globally known projects, very unique projects, and the value of these projects has been accelerating. One of the most projects that the value has accelerated and is the Palm Jumeirah project. Other projects we do have, our growth rate, return on investment varies a minimum of 8% and it goes up to 13% and is increasing. And because of sometimes the geopolitical things that are taking place, we have a great influx of people coming here, seeing the UAE as a safe haven and investing in property. And when you invest, you know there is a good return because there is strong demand in the market. This is the first freehold project that was introduced 25 years ago in the UAE, the Dubai Marina by Emaar. Some of the beachfront projects, apartments, penthouses. We have things to cater for all budgets. So if you want something low budget to own, we have it. High, luxury, super high. We cater to all budgets. And that goes also for business. Now, just to wrap up, everything that you have here is pro-investments, easy to set up. You don't need a lot of consultants to do that for you. Very much easy. Just contact the Free Zone Authority. The chambers will be able to help you. CEPA agreements will help you. Whatever agreements, trade agreements United Arab has, your business will grow, and your business and your products will be very competitive in other markets because of our agreements. Even the Arab League agreement gives you access to more than 19 markets, and being duty exempted if you produce in the mainland. Strategic location in terms of connectivity, ownership, different free zones to cater to different entities. If you're into the commodities business, we have DMCC specializing in that, re-exporting, packaging, etc. We have many free zones to cater to your specific business needs. So make sure you get acquainted and get the right information from the chambers, because I met a lot of people yesterday and they were confused. They didn't know where to set up. They were saying that, I don't know, my lawyer doesn't tell me where to set up. I said, it's very straightforward. Just contact the official authorities and they will give you a very transparent idea about what's best. And to conclude, I would recommend that you consider this market. It's affordable, it's connected, it's pro-business, and it's ideal for families, and you can access international markets using the UAE. The UAE has based its products and given high quality to whatever has been exported out of the UAE, whatever has been produced in the UAE. And this has been recognized by international markets buyers. We've got the best arbitration centers, recognizing common law, the best banks to facilitate your business, LC, etc., credit shield, insurance to support your business. Before I close, these are the promising businesses that are growing right now: healthcare, agri-tech, space, ICT sector, tourism, renewable energy, fintech, entertainment, streaming, and gaming. There is big emphasis on that. Smart cities, as I said, the country is looking at becoming one of the smartest cities in the world. So these are growing at the moment. Now, when we look here, these are the promising sectors for foreign direct investments: agri-tech, healthcare facilities, therapeutic devices, IoT and sensors, sustainable transport. We have huge funding for being sustainable and using green transport systems. EdTech, consumer companies, robotics, carbon capture technology, because all of the businesses will be heading towards checking how much carbon footprint they've reduced, because the government is heading towards that. Immense pressure on that to make sure that we have a clean and safe environment. Blockchain, we have a strategy on blockchain, so whoever is in that part of the business, this is an ideal sector. Artificial intelligence, virtual intelligence, e-commerce platforms. We are one of the center places in the GCC for e-commerce, followed by Saudi. Very high internet penetration, very high door-to-door services. Supply chain infrastructure is there to support the e-commerce business. So if any of you are into that or into IT related to e-commerce, that's a growing sector and that's a promising sector for you to invest in. And before we close, our leaders focus on the power of people and human capital. And everything that we have here is focused on giving the best services to people living in the country, transiting, visiting, etc. So there's huge emphasis on human capital. And I think this is one of the secret recipes. Whatever we do, it's around people and serving the people of the country. Sorry for taking so long, but thank you for being here with us, and we're very much happy to assist you in any way possible. Thank you so much.
Thank you. Thank you very much, Nadia. But don't move, because we've got one or two questions from you that have come in online. And I'm going to relate the questions as I get them. So first one, is the diverse population and the speed of decision making, in your view, the key to the success of the UAE?
The key success is, first, the visionaries, the past visionaries who saw we were a desert, and the past ruler, the father of His Highness Sheikh Mohammed bin Rashid Al Maktoum, decided to build the largest man-made port in the middle of the desert, in nowhere, in Dubai, Port Jebel Ali. And that has brought in a lot of business. Focus on taking all the income coming from the oil business and spending it on the infrastructure, soft, hard. It was a great move, because once oil runs, what are you going to do? You need to be well prepared in advance. So that helped shape our business, and welcoming everybody and educating people and making sure, first of all, it's a safe place. So the Dubai police and the federal police are doing a great job in terms of making sure everything is safe, secure for the residents of the UAE. And when you feel secure, things will fall into place. And the legislation also that protects international interests, having common law practices at the IFC, having the arbitration, global arbitration centers, help people have the confidence. And seeing it year after year being stable gives the people reassurance. Having the open door policy, if you have problems, there is the ruler's office, the Diwan, to go and speak. So that open door policy has been there for many years, speaking to the investors, the business people.
Well,
that helps. That really helps, I think.
wonderful. And there's one more question, and it's addressed to you in your capacity as president of the National Association of Freight and Logistics. Do you think the incredible growth pace in the logistics sector can be maintained in the UAE and the region?
Definitely yes. But growth also by updating ourselves, looking at the latest technology to support the business. Of course, there's competition everywhere. People are copying the model that we have because they've seen it's been very successful, but always being a step ahead, always giving the consumers more than what they expect, enhancing the experience when it comes to importing, exporting, re-exporting is key, and using international trade facilitation tools effectively and seamlessly will help keep us in that position.
Thank you very much, Nadia. Can we give her a big round of applause for an enlightening presentation?
Thank you.
Thank you, Nadia. Really, really wonderful. And of course, Nadia mentioned competition, and we have a competition that tomorrow morning. We have the Trade Tech competition looking at the latest and greatest technology in facilitating trade tomorrow morning. So now to proceed with the proceedings, and again, Habib is sending me some comments and inspiring presentation from Miss Nadia. So thanks, Nadia. So you're doing well. Still no comment about me, guys. Just get your act together. You know, you need to say something good about me. So we're moving now into the central theme and the core work of our work today and tomorrow. And the next session is we're looking at the multilateral development banks sustaining trade in challenging times, and these are challenging and unpredictable times. And our friend Mark Oban is going to, from the WTO, is going to lead this session. And Mark, I know you're oh, thank you. Could we give Mark a round of applause? And I think your first panelists can also join him on stage. Yes, please.
Good morning, everybody. So I'm Marc Auboin. I'm from the World Trade Organization, and I have a great panel, and I will introduce them. But it is a little known fact that despite all the challenges of last year, and to name a few, the COVID response, Mr. Beck, conflict in Ukraine, food crisis, support to vulnerable countries, as a matter of fact, there's a lot of distressed countries right now in the world, and it is a very little known fact that world trade has reached a record, all-time record. We are still gathering the last numbers, but we should fall around 25 trillion in world trade. That is about, guess what, about 20% higher than pre-pandemic in 2019. So 20% higher, 25 trillion in goods. At the same time, we are behind potential. We're behind potential because there's shortages of trade finance, and this is what we will be talking about. A lot of traders do not have access to trade finance in the world, and having no access to trade finance makes you either a non-trader or makes you a less efficient trader. Just think about any SMEs that have to import anything and has to pay cash in advance. advance payments, which is still relatively frequent in the world. That means that it has to use its own cash. There's a huge opportunity cost of doing so without having the certainty to be delivered. So lack of trade finance is a missed opportunity. And therefore, this is what multilateral development banks are trying to do, which is to bring private sector capacity in some of the underserved markets in the world. According to the Asian Development Bank, there's a $1.7 trillion trade finance gap. And we are going to talk about this mainly about trade finance in two ways. But before I introduce the themes of the panel, I will introduce the participants to the panel. I have here on my right Mr. Basel Al-Hussein, who's from the Private Sector Advisory Department of the International Islamic Trade Corporation, Trade Finance Corporation. I have then Makiko Toyoda, who's the head of the Global Trade Finance Program of the IFC, the International Finance Corporation, which is the private arm of the World Bank. We have Steve Beck, who's the head of the Trade and Supply Chain Finance Program of the Asian Development Bank. And we finally have Mr. Dr. Putz, the head of the Trade Finance Facilitation Program of the European Bank for Reconstruction and Development. And these colleagues are actually working all together to try to fill some of the world's trade finance gap, as well as building capacity in the markets I was talking about. So basically, this discussion will be organized around two questions, and so it will be looking a little bit backwards at the trend of the past 12 months, despite the record level of trade I was talking about. There has been those challenges, COVID response, conflict of Ukraine, huge amount of reallocation of trade to be done, given these organization of trade in the Central European region, as much as people, running around to find wheat and basic commodities as a result of the war. How have your institution supported markets and trade and built the capacity in trade finance we were talking about? That would be my first question. And my second question, then when we have had the response, would be looking ahead in the next 12 months down from the road. What do you expect, and what are the main challenges that you face? So coming down to the first question, looking backwards a little bit on the trends of the past 12 months, how have your institutions supported markets and trade? And I want to emphasize here the exceptional counter-cyclical role of multilateral development banks. I have been through the global financial crisis and was instrumental in putting together a $250 billion package in support of trade finance market. At the time, multilaterals were intervening by amounts of around 15, 20 billion. Last year, altogether, they did 50 billion. 50 billion. So this is what they brought to the market in support of the private sector, some of which was withdrawing, right? So starting with Basel, and then we will go on my right. How did you address the challenges of the past 12 months?
Thank you, Mark. Before I answer the question first, I would like to thank ICC UAE and Dubai Chambers for hosting this excellent event. Very well done, and hopefully it will be a success to build further into the future. In terms of how we did and what challenges that we faced during the past year or more, as you all know, COVID hit hard our economies in member countries, made a lot of turbulence in the markets, affected the supply chains, and this impacted negatively our member countries in terms of securing necessary medical equipments, necessary vaccines, food security issues that they were necessary for the livelihood and economies of those member countries. And right after that, the war between Russia and Ukraine hit, and that impacted the supply chain for food securities as well. So it has been very challenging times for us and our member countries. And we exerted our efforts to do our best and to help the member countries addressing these issues, as this is our mandate being a multilateral developmental financial institution. So within taking at heart this mandate and trying to achieve the best that we can within these circumstances, we managed to increase our trade financing services to our member countries from 4.7 billion in 2020 to 6.8 billion US dollars in last year, which is a remarkable increase in terms of trade finance facilities granted to secure energy supplies, food security supplies, and support the private sector in our member countries. Out of that, about 4 billion US dollars was granted in the Asia and Middle East region, while 2 billion was granted in the Africa region, and the rest of about a little bit more than 700 million was designated to support the SMEs through partnerships with financial institutions in our member countries. All of this reflect a great increase in our activities. To achieve that, we did a lot of changes in our business models. We adopted, or not adopted a new strategy, but we changed and enhanced the strategy a little bit in terms of addressing these challenges, to be resilient, to be flexible, to get out of the ordinary and introduce innovative solutions to our member countries through product development, through offering new services, through establishing new functions at ITFC that can address the needs of our member countries in these terms. So as a multilateral, we took very serious the burden and the promise that we provide to our member countries to provide their support needed. And alhamdulillah, we managed to achieve an excellent work in this area. Thank you, Mark.
Thank you so much, Basil. It is a testimony to the counter-cyclical role of multilateral development banks. And I would like to turn to Makiko Toyoda. How have you been going through that exceptional surge in demand for your products?
Thank you, Mark. And I also would like to thank Dubai Chamber for hosting this event, and thank you for ICC UAE for inviting all MDBs, including IFC, to this stage. I would like to share some information about how we performed for the last 1 year. And thank you, Basil, for the comprehensive information about ITFC. This is really interesting to hear about other MDBs update as well. As IFC, we are currently experiencing historically high transaction volume at this moment. And this is about 30% growth year on year. This fiscal year, we might hit historically high commitment amount, which is between 14 billion and 15 billion US dollars. If I look back 1 year, it started from the Russian invasion of Ukraine, and we experienced the food and energy crisis, inflation, high commodity price, and also the country default in some of the challenging markets, also country downgrade. All of those factors came into a place where we received high demand from the emerging markets. If I look back 2020, our percentage of low income and fragile countries was 55%, which was still high at that point. But as of today, the percentage of low-income countries is 73%, and this is historically high, which means that it indicates those emerging markets, high-risk countries are severely hit by those poly-crises, and then they need IFC or maybe other MDBs trade support, and this is why we are recording highest volume from those countries. We approved 450 banks from 100 countries in the past since the inception of our program, which is about 2 decades. But we tried to add new countries during this crisis. For example, Djibouti or Ethiopia, those are new countries that we added. And then we are still pretty active in the countries like Ukraine, maybe Ghana, where the country defaulted, but we are still operating. And then, or maybe country like Pakistan. The last week, we issued a guarantee for those 3 countries, Ukraine, Ghana, and Pakistan. The market is pretty challenging, but then working together with our partners, we think that we would be able to deliver those trade finance guarantees to those high-risk countries. To date, for the past 20 years, we have never experienced default. We are still keeping this zero loss record, and then we hope to continue this work. So far, Africa is the largest region in our portfolio. During the COVID, it was about 36%, but as of today, the Africa percentage is about 38%, so it is increasing a little bit. In terms of the sector, right after the COVID hit, our food and agri percentage went up to 40%, which was also historically high. Now it's going down, but then still we are supporting food and agri for about 30%. This is still pretty high if we look back all over 20 years of history. But then this is maybe pretty unique in the crisis, that the demand of those import of food, or maybe other critical goods like medical equipment, other goods are increasing. So we are trying to accompany the needs of those food import as well. So working together with WTO, we did a trade finance gap study last year. We focused on 4 countries, Senegal, Ghana, Cote d'Ivoire, and Nigeria. And those 4 countries, we identified the trade finance gap of $14 billion US. So this was really a great exercise that we worked together with WTO, and I would like to thank Mark for your leadership, because our team relied on Mark's leadership to conclude this study. And then out of this study, we have started implementing new action plans. One is that we started ATRI, which is a new program, which is called Africa Trade and Supply Chain Recovery Initiative. And then based on that initiative, we implemented 6 innovations, innovative products. The 2 themes that I'd like to share with you today is one is the SME trade, and the other one is the supply chain finance. So those are some of the new items that we are adding in this initiative. So moving forward, I think we are looking forward to try new things, implement new strategy, but then this portion is maybe I'm going to answer in the second round. Thank you.
Thank you very much, Makiko. And I would like to emphasize the high level of cooperation between multilaterals during that time. These times of crisis and uncertainty are times when the financial sector is still responding to the demand, but in certain regions they are pulling out as well. There could be a reduction in correspondent banking relationship, there could be reduced lines and higher risk perception, and in that case, multilateral developed banks are using their network of hundreds and hundreds of banks they're working with around the world to provide the comfort and the certainty to be able to continue operation in certain countries which are not necessarily being high risk at the time, but which perception of the risk is high. And I would like to turn to Steve to have his perspective. We've been through the global financial crisis together. How do you, how have you been through that one, which we have gone through in the past 2 years?
Thanks, Mark. Good morning, ladies and gentlemen. Many thanks to Vin and ICC at Dubai for hosting this event. It's a great opportunity to come together and discuss these important issues and talk about how we can try to resolve them together. Mark, you made reference to this $1.7 trillion gap, unmet demand for trade finance that we estimated about 1.5 years ago. And with the advent of a significant amount of inflation in the economy, ADB increased that estimate to about a $2 trillion gap. But I don't think any of us would be all that surprised if, in fact, it's actually bigger than that. The impact of inflation on the gap cannot be overstated. If banks around the world have a certain amount of credit available for a country and for counterparties, and if suddenly the value of transactions to be supported under that same line is in real terms reduced because the prices of especially a lot of commodities, as you mentioned, Makiko, agricultural goods and so on, have increased, in effect, the amount of availability, amount of available trade finance to support more transactions has shrunk, right? When you throw into the mix the perception of the risk environment, I don't think you've got a lot of financial institutions increasing limits, country limits and counterparty limits, certainly not in a lot of the markets that we're working in. So the gap is a real issue, and as my colleagues have been saying, I think that in large measure, our work and the results that you see in terms of what we're providing in terms of guarantees and loans, in many respects may be considered a proxy for that gap, right? Because presumably the private sector, you are partners. If you don't need us, you're not going to use us, which is great. But we're seeing, as my colleagues have said, a substantial amount of demand for multilateral development banks to step in to partner with you especially in these more challenging markets. So over the course of COVID, we saw our transaction volumes increase by over 50%. Last year, we did a bit less than $8 billion in loans and guarantees to support trade, mostly guarantees. Over 90% of our portfolio is in guarantees. As has been discussed, it's a challenging market. We do have the effect of inflation, which is also eating at hard currency reserves in a number of countries. You've also got increased interest rates, which is also having a similar impact. You've got deflation, rather a devaluation of a lot of local currencies, which again exacerbates this challenge of importing critical goods, especially food and energy in many cases. And all of this is reducing the availability of hard currency in many of these countries. So we have Sri Lanka, which has been a big challenge for us, of course. Pakistan as well is quite a challenge now. These are markets that we continue to operate in and coordinating very closely with colleagues, including the IFC. And we wouldn't be surprised if there are going to be other countries that, for all of these sort of reasons, continue to experience strain. So we have to be vigilant, and there's no question that there's a role for multilaterals in this space to close gaps, but also to respond to crises. We've been talking about different instruments that we want to scale. We met yesterday, and some of the discussion was about certainly closing gaps on the traditional trade instruments, but also in open account. And I think there's some consensus that we're all pretty keen on building supply chain finance capacities to close gaps. And there are some very exciting opportunities, especially to close those gaps among SMEs with the supply chain finance as an interesting sort of vehicle. One of the things that we'd like to see what we can do is to address this sort of challenge with supply chain finance for all of its advantages. Typically, it tends to support the first tier supplier in a supply chain, and it's the second, third, and so on tiers farther down, typically that tend to be the smaller sized companies that get left out. And so there's some interesting opportunities maybe in something called deep tier supply chain finance that we're trying to sort out now, including with the Bankers Association for Finance and Trade. There's some legal and technical issues with that. But the point is that there are these gaps. Certainly SMEs are among the most underserved, and we need to do something about it. And there are some exciting opportunities to fill these spaces. Thank you. Thanks.
Thank you very much, Steve. You're right to point out two things. One is the fact that a lot of markets are underserved. I mean, when we're talking about a 1.7 or 2 trillion dollars unmet demand, this is just our estimate of global rejection. That is, when someone asks for trade finance, it's being rejected. So that is just the rejection rate. But we realize, and I will be talking about that in the next session, that a lot of companies are not even asking. And so this is what is coming out of Africa, which is in a lot of developing countries, collateralized-based lending is actually preventing companies from even asking. If you ask for 100% cash collateral to guarantee your loan, well, where is the collateral going to come from? If you're working in an export processing zone, you're landless, you're cashless, you're doing service, sometimes just service contracts, you're not going to have the collateral. So you're not even asking. So we are trying to find solutions to that. I mean, the banking sector is offering solutions, but in relatively developed market environment where there are supply chain finance platforms and so on. And we are trying to think about environment in which there are no platform, there's little infrastructures, there's, you know, flexible creditors' rights and so on and so forth. This is the kind of environment in which we are working. But I'd like to turn that is something we really think about because the other important point is we're looking ahead also is we've been through a period where there have been shortcomings in supply chains, and we know why. Yeah? So there were COVID, people were sent back home, you know, people on ships were quarantined, people were opening and closing and opening and closing. So, and despite that, by the way, we missed nothing. I mean, so we had no shortages of, or we had shortages of very few things. But at the same time, what is important is to think at the next stage of globalization and think about those having more inclusive globalization whereby you need more suppliers, right? You're going to need more suppliers around you, and you need more suppliers in the developing world where you have untapped suppliers yet. And this is where we need to bring the next frontier of trade finance. But coming back to Rudolf, Rudolf has been, I mean, Rudolf is always an innovator in the EBRD's trade finance program, and the innovation this time is that trade relations have been completely upside down in your region, and you had to create again, and you managed to bring some wheat out of Ukraine going down to Egypt, right? And so how did you do that? And how have you been, what have you been through in the past 2 years?
Yes, so thank you very much, Mark, and warm welcome to you, all of you, to this conference. Our trade facilitation program was created more than 20 years ago, and it supports the development of trade and trade finance in EBRD's countries of operation in Eastern Europe, for CIS. And in the last years, the EBRD has expanded also to the Mediterranean region. So our countries comprise now also all of southern and eastern Mediterranean countries, including Morocco, Tunisia, Egypt, Jordan, West Bank, Gaza, but also countries in Europe like Greece, or our countries close to Europe, Turkey. Under this program, we provide guarantee facilities, loan facilities, and technical assistance to our partner banks with a specific focus on smaller countries and with a special focus on the development of trade for small and medium-sized enterprises. As you can imagine, the start of a war on Ukraine had a dramatic effect on our business. Traditionally, Russia, Belarus, Ukraine, they had been major recipients of our support, but all of a sudden there was a war, and all of a sudden farmers in Ukraine, they were suffering from a lack of finance, because when the war started, all commercial banks stopped lending to Ukraine. Nobody wanted to take any more risk. Export credit agencies, insurance companies, they all said, we cannot finance you anymore. But farmers in Ukraine, and the war started in spring last year, all of a sudden they needed financing for the import of fertilizers, for the import of seeds, for the import of crop protection chemicals. And for goods were available, but nobody wanted to finance the import into Ukraine. And we had the facilities available. So we work with 10 partner banks in Ukraine. We increased our facilities for our partner banks in Ukraine, and we financed for import whatever for farmers needed in Ukraine to produce grain. So we helped for farmers to produce for grain, over for spring, over for summer. But then there was a next challenge, because it was in October when the grain was harvested, but they could not export because the logistics didn't work. The ports were closed, and traditionally Ukraine had exported for grain by ships, and the major destinations for grain were countries in the Mediterranean region, countries like Morocco, Egypt, and they all needed this grain. And the grain prices increased, and Ukraine could not export for grain. So we helped to redirect the trade flows by railways. A lot of grain was exported by railways and transported by lay rails and trucks to the Baltic countries, to Poland, and then shipped to the Mediterranean countries. But then we had the next challenge, because the importers all of a sudden they had needed much more financing for the import of grain, because the grain prices had increased. Sometimes they had doubled. And the importers became very cautious. Not only that they imported the grain which they needed for the next month or for the following weeks, they needed to have stocks because they were afraid that we would run out of grain. So all of a sudden we had to finance not only increased commodity prices, but also longer storage times. So the demand on the import side in Morocco, Egypt, Jordan, West Bank, Gaza on food increased, and we had to increase our lines and to provide much more longer tenors than we had expected in the past, because traditionally trade finance is a short-term business. But now, if you take the whole crop cycle from producing a grain until for renewables, you need 18 months. So all of a sudden, our demand for our financing increased. Another side effect of this war in Ukraine was that many commercial banks, they stopped lending not only to banks in Ukraine or in Russia or in Belarus, the countries we were involved in the war, but they said, if we don't earn any money anymore in Eastern Europe, we just withdraw also from other countries, from countries in Central Asia, from Caucasus. These are small countries. If they don't bring much profit, why should we continue lending to them? And we stopped for correspondent banking relationships. And all of a sudden, these small countries in Central Asia and in Caucasus, were left without any correspondent banking relationships. So we had to guarantee 100% of a payment risk of commercial banks, so that we continued to lend and to finance trade also in smaller countries like Kyrgyz Republic, Tajikistan, or Moldova, countries which are close to the whole region. So it was a very challenging year, but on the positive side, we had no losses. It was surprising that we took enormous risk, and we had no claims, no losses. Yes, we had to extend guarantees because the tenors became longer, but so far it has gone good. And I think it shows that our partner banks have selected their clients well, that they took security, they knew their clients, and they continued to finance the business.
Well, thank you very much, Rudolf. And I think I can feel in the room there's a big appreciation for the work you're all doing. 15,000, I've done a kind of back-to-envelope calculation. I'm not sure I've ever talked to you about it, but I think you are all supporting all together, supporting about 15 to 17,000 trade transaction, physical, real trade transaction a year in the world, in the most challenging countries at war, post-conflict economy, countries in distress, but also building the capacity in the poorest countries where eventually the banking sector is able to find growth opportunities. Now, turning to the last 15 minutes of our discussion, I would like to turn a little bit to the future. We've been speaking about, supporting the expansion of supply chain finance. We find indeed that in the sort of developing emerging markets, this is, as we said, one of the growth areas, because typically, buyers program would cover the first tier of suppliers, but the second tier is not supported locally. Secondly, we've been talking between us about greening, the requirements to green the trade finance facilitation programs. There's also digitalizing trade finance. What are your own challenges in your own institutions with respect to your program? If you could spend about 2.5 minutes, each of you, starting with Basil.
Thank you, Mark. Still, the challenges are not over. So thinking ahead, there is a lot of things that needs to be done. We are working on several initiatives that can contribute to growth in the future and providing support to our member countries. But the most important thing that nothing can be done alone as a multilateral institution. We rely and we have a strategic thinking of partnerships with the other MDBs, especially in the areas that are mutual focus, such as climate financing, such as contribution to the supply chain in our member countries. These are very, very critical subjects that none of the MDBs can work on a standalone basis, but through partnerships, a great success can be achieved. Now, at the level of ITFC, we are introducing many new things to our member countries that can contribute to the economic enhancement, development, and to the institution growth. We are developing new financing products that can help our member countries even grow their energy and supply, food security supply, and support the economic development in these countries. We are launching very soon our advisory services function that is aiming to help member countries in providing many other aspects other than the financial aspect. We are developed, or just last week, we announced the launch of our KSA SMEs program, development program, which aims to support the Saudi SMEs in developing their export activities and increasing their non-oil exports, which will be reflected in the GDP growth of the country. We are very soon also launching the Central Asia Trade Development Program that is currently being developed and designed by our trade development team. This will help the Central Asian countries to intertrade between each other, to provide capacity building solutions, technical assistance, etc. In terms of trade finance, we have a great focus on private sector financing. So we are aiming to also onboard new financial institutions more and more in the new countries as well as in the existing countries, and increasing that particular portfolio, if not double it, inshallah. In terms of diversification of our portfolio, we are focusing on food security aspect more and more. Food security was just representing around less than 10% a few years ago. Now it's the second major portfolio in ITFC. Energy was representing more than 85% of our portfolio. Now it's only 60%, and we're hopeful that we can reach a balance in our portfolio. We also are working on our sustainable and ESG policies internally, that not just only for the corporation, for ITFC, but for also to offer solutions to help our member countries in these aspects. So a lot of things are being done by ITFC, and in the coming 2 to 3 years, you will hear great announcements from ITFC and a great announcement from partnership with other MDBs as well. Thank you very much.
Thanks, Basil. Makiko?
Thank you, Mark. And I totally agree with Basil in terms of the MDB's collaboration. This is key for us to work on this challenging market at this moment. As IFC, we would like to focus on two things. One is SME trade, and the other one is supply chain. In terms of SME trade, we got approval to risk share the underlying transactions when we provide the trade finance guarantees. So this is a way for us to focus on those SME trade, and where possible, IFC is going to take the risk of underlying transactions, working together with Yushin banks. We have an approval, but we haven't started yet, so hopefully we can launch this initiative this year. Also, SME workshop. This is something that we are currently working with WTO, and Mark and our team have delivered SME workshop in Cote d'Ivoire last year. It was pretty successful.
And in Kigali next week.
Yes, and next week we have one in Rwanda. So those workshops are pretty informative, and we hope we can actually strengthen the capacity of those financial institutions that would like to serve SMEs. One more thing we recognize through some activities, research activities last year, was that supply chain finance gap. That we did a study to identify gap in 5 countries, Nigeria, Cote d'Ivoire, Uganda, Kenya, and Angola. And then based on those supply chain finance gap studies, we also did a workshop. And then, for example, like Nigeria, this workshop worked pretty well, where we invited like 60 bankers in the room, and we also invited Central Bank of Nigeria. And so it's actually, what we saw was pretty live discussions that the bankers actually expressed their wishes, their complaints, their suggestions, proposals, where I think the legal side of the work is still needed. So as IFC, we are also active in the legal side, that we tried to create a legal framework. We tried to create a national supply chain finance platform working together with governments. So selectively, we are also working on the legal side. But at the same time, we also would like to strengthen this advisory component for supply chain, where we provide opportunity for bankers to learn about the new supply chain finance techniques. We also established a new program, which is called the Global Supply Chain Finance Program, GSCF. And then because we got the envelope from the board, we would like to roll out this program this year. We just got approval 2 months ago, so we haven't done any pilot exercise yet. But we are hoping to work on some of those supply chain finance initiatives under this new program. Last but not least, about 80% of total carbon emissions are coming from supply chains. So we are also interested in reviving our climate training programs, which we were active pre-COVID. And after COVID, we haven't engaged any climate training yet. So we would like to revive this climate training by using maybe 2 types of guidelines. One is IFC's definitions and metrics on climate-related activities. This was a publication done before COVID, but then this is to disseminate the definition of climate-smart trade, so that we can work together with our partners and also other MDBs, that we can work collectively to raise awareness of the market in terms of the importance of climate transactions. And also the other guidelines that we would like to share is common practices, the principles for the climate mitigation finance tracking. So this is also important for us to track those transactions. And sometimes financial institutions have access to better sources of funding through Treasury if they book climate-related transactions. So what we are hoping to do is that when we identify those climate transactions, we book and we flag it in our system. But before that, we maybe didn't communicate with our partners that as IFC, we identify this transaction as climate eligible. And so we are booking this as a climate transactions. So we are hoping to share this type of information so that you can also you are able to track those climate transactions, and then we can increase those climate transactions and promote ESG agenda in the supply chains moving forward.
Thank you very much, Makiko. I think the message you're getting here is that should you want to work in the emerging market, work with multilaterals, please do. I mean, they have conducted more than 150,000 trade operations in the emerging market and ever had any claim, right? So get that in mind. Steve and Rudolf, we've got another 3 minutes each. So what's your punchline for the future?
The punchline? Well, it is. I think the global conversation around trade and supply chains has been transformed by COVID, right? I mean, very few people were talking about, okay, maybe a bit about trade, but certainly not about supply chains and how important they are and so on. So I think it's a very exciting time to be in this business. I mean, there are all sorts of things that we need to figure out, and I think that we're quite conscious. While the focus had been, and I guess to a large extent continues to be, around closing gaps to provide more financing for the growth that fuels more development. Now I think we see our remit as something that's a lot broader, right? So Mikiko made reference to the statistic that about 80% of the global carbon footprint can be traced back to trade and supply chain. So if we don't figure out how to green that whole process, we're not going to be able to achieve our climate goals. But these are very, very complicated things, right? I mean, as everyone in this room knows, how do you operationalize that? And so, including yesterday when we were meeting to talk about, how can we coordinate to provide some more, I guess, maybe guidance in partnership with the market, with maybe people in this room around, as Mikiko is saying, what does constitute a climate finance deal? What's green? How do you prove that it's actually green? Well, we're going to try to harmonize that. There's a lot of different information coming at all of us on all this kind of stuff. It's extremely confusing. So Mikiko made reference to this initiative to talk with the market about, what are those standards and how do we coordinate better. So that's certainly something on the green side. Resilience, we know that resilient supply chains, very important to getting goods to where they're needed and when they're needed. It's not just medical supplies and equipment, but it could be anything, right? So the digitalization of trade, we're very active on that front as well. To digitalize some 30 documents that are required in the physical movement of goods, but also the legislation that's required for governments to pass to be able to recognize those digital documents. Because, most governments actually don't have legislation that recognizes an electronic document as opposed to, the hard copy. So these are things that we're working on together. Transparency in trade, of course, very important. Money laundering, trade-based money laundering. There's some initiatives that we're undertaking there. Social responsibility. Of course, it's incumbent upon all of us to ensure that labor standards are being met throughout the entire supply chain. Again, it's not an easy thing to do. Maybe for your immediate supplier it is, but what about, the 5th supplier down the chain or the 8th or whatever it is? Complicated. So these are some of the things that we're looking at, as well as some initiatives around disability. How do we include more of the disabled in finance and trade? There's some initiatives that we're launching. So that's my elevator pitch.
Thank you very much, Steve. And Rudolf, you have the word of the end. So
yes,
please.
So I think what we have learned on this panel that for development banks we have for tools, we have for capital, but we should not forget that we can operate efficiently only in cooperation, not only between our institutions, but also with the private sector, with commercial banks, with insurance underwriters, with export credit agencies, but also for important role, I would like to underline the important role of associations. Associations like the International Chamber of Commerce, like here in Dubai, associations like FCI, who are supporting the development of factoring and supply chain finance in our countries of operation. And these associations, they bring in a network of members, but they bring also know-how. And they present this know-how at conferences, and I would also encourage all participants to join these associations and to use the training opportunities, to use the conferences, and to join also these associations, because these associations, they bring in knowledge, and this knowledge is particularly needed in countries in emerging markets. So cooperation is, I think, is the key to success of all our institutions.
Well, with this, you realize that we have ended on time, as someone based in Switzerland will make a point at, and I think, yeah.
And Mark, no questions because your moderating has been wonderful, but there have been some comments coming in on the chat, which Habib has actually forwarded to me. So I'm just going to share a few of them. With commercial banks pulling back from difficult markets, the work of the MDBs is commendable. That sounds pretty good. The second one, to be able to export to some of these markets with the guarantee of the MDBs is incredible. I was not aware of it. Okay. Third one is that the MDB support is essential to maintaining our correspondent relationship. Okay. And there was a lot more. And finally, guarantees issued to the countries Ghana, Ukraine, and Pakistan in the last week is walking the walk, not just talking the talk, but walking the walk. So congratulations, everyone.
Well, thank you very much.
Absolutely. Could we give them a big round of applause? Really, it's commendable work, and thank you, Mark.
I wanted to emphasize also that you know, we are happy that the ICC hosted us, but beware, the WTO, the World Trade Organization, will hold its first ministerial meeting in the UAE next year, so in Abu Dhabi. And I would like to emphasize that. Prepare the 3,000 delegates and the 2,000 journalists. It's coming to you.
Yeah, and we're here to support and do anything we can do to facilitate. So now we're going to have a coffee break, and we'll be back sharp in the room at 11:20. And again, we'll be moving on in the trade facilitation, looking at Africa, the final trade frontier, again, moderated by Mark Obon. So enjoy your break, network, but be back at 11:20. Thank you very much. Thank you, everyone. It's wonderful that you're coming back into the room in a timely manner. So please come forward and sit near the front. I think you will get a better view, you'll get a better interactive experience. And it means then when I'm handling the questions and answers that it will be all that easier for me to do. So exactly, perfect, yeah. I'm really delighted. As we know, China's opening up, and I just see come in the door my very good friend, Jin Saibo from Beijing. So you're very welcome, Mr. Jin, but move down and take a seat near the front, and we get underway. We get underway with the next session, pretty reasonably in line with the timing on the program. Yeah, so come forward. You'll be more involved in the program if you come a little bit forward, because we're moving into a very exciting session, and we're looking at Africa, the final frontier. And again, this is looking at their work, the great work of the multilateral development banks in keeping trade and supply chains open in Africa. So good to see you all. I'm going to share while we're getting ready a few comments that I have received on the app, and we have a message from our very good friends in Bank Leumi in Israel, and they said superior content. Keep up the good work. So thank you very much. I think the content actually is superior, so we will do our best to keep up the good work. And someone said a wonderful program, and if I may just say a word about the program before we start. Some of the critical issues that were identified by the MDBs in the last panel are on this program. So immediately after lunch, we have a deep tier supply chain finance. Immediately after that, we have a case study from the corporate perspective using deep tier finance. Immediately after that, we have a case study from one of the banks in the UAE in the development and rolling out a supply chain finance program. And then after that, we're moving on with sustainability in the supply chain. And after that, then we come to trade transformation through technology, time to speed up, where there is we have a little bit of debate, are we going a little bit too slow? And then that will bring us to the end of our program in a timely manner at 5 o'clock. But now we have a large group, you're all back in the room, and are we online? We're online. So moving forward with the program, Africa, the final frontier. This will be led again by Dr. Mark Obon. So Dr. Mark, if you can join us on stage with your panelists, and we'll get underway. Thank you. Thank you.
So this is me again. Sorry about that. I have now a very good panel discussing trade finance in Africa, and this is indeed the new frontier. This is where everybody wants to be. If we are talking about diversification of supply chain, this is certainly one area that people are looking into. There's a lot going on. The free trade agreement of the African continent. There are, as you know, 8 countries which are now piloting and that have already gone duty-free between them. I think one of the objectives is to develop African supply chains, not only African-centric supply chains, but also supply chain integration with the rest of the world. There is here the significant opportunities with respect to developing trade finance. We are looking into these opportunities by doing studies along with the African Development Bank. We are kind of evaluating the markets. And I would like to bring in, please, on the floor, Lamine Dramé, who's the head of the Trade Finance Facilitation Program for the African Development Bank. I would like to ask also Khalid Ben Ali to join me. He's the head of the African and Middle East department at the chamber, if my notes are right, but he will tell you exactly. And the way the panel will work is the following, because we should have had one more guest, and that guest, Gwen Mwaba, the head of trade finance at the African Import-Export Bank, Export-Import Bank, which is the Afrexim Bank, was scheduled, but unfortunately she could not be with us, but she did a video. So the way we would run now is I will start the conversation with Lamine about the potential and opportunities in Africa. Then Khalid would come with us, and we will end with the video, because Gwen was kind enough, although she could not be here, to do a little video for us. And so we will run the video at the very end of the panel, and I would conclude. So, let's discuss with Lamine on increasing the flows of trade finance to maximize the trade potential in Africa. In this vein, I'd like to remind that the African Development Bank has pioneered trade finance gap studies. I want to emphasize here that, all the multilaterals here that you've seen in the previous panel and that you're seeing now are joining forces on providing common goods as to evaluate the trade finance markets and the gaps. So we have the ADB, who's taking on the Global Trade Finance Study. We have the African Development Bank, who's doing the Continental Trade Finance Gap Study. And the WTO and IFC are now doing what we call sub-regional studies, because we think that it's important for policymakers also to relate to some of these regions that are expanding, that are emerging, and to see what is the impact in a particular country or in a particular region of not having trade finance, the impact of how much trade do you forego by not having trade finance, and what is it in those particular sub-region that you can do to actually increase the potential for trade finance. So let's come back to Lamine, and could you just tell us a little bit about your efforts to do this diagnostic?
Thank you very much, Mark. Good morning, ladies and gentlemen. It's a pleasure to be here, and thanks once again to Dubai Chambers for hosting us, and to ICC UAE for really organizing this. It's a pleasure to be here. We were here last year, and we are back again this year due to the success we registered. Now, Mark, thank you very much for that question. We started off in trade finance in about 2013, and at that time, we were wondering what sort of gap or challenges were in Africa. When we ask around, some people tell us that the gap is about $25 billion. But when we further probe that and ask, where is that coming from? It seems to be just finger in the air. So we really didn't know what the source of those were, how valid they were. Are they really based on evidence, service, and so forth? So to help us really launch our program, and we actually are the youngest MDB trade finance program of all, we had to learn a lot from others as well. But at the same time, we need a lot more evidence to convince our board that this is an area we want to be in. So we started off with conducting a continent-wide trade finance survey. First one was done in 2013, covering 2011 up to 2012. And then since then, we've done 2 other rounds, talking mainly to banks, finding out what the challenges are and estimating the gap. So we've done 3 of that, now covering 2011 to 2019. We have surveyed 670 banks in 49 countries, 49 out of 54 or 55 countries in Africa. 670 banks were surveyed over this 10-year period. And the gap in trade finance is estimated between 80 billion and 120 billion. When we started, it was about 120 billion. The last study we did in 2020, now that we've refined the processes of doing the estimations, put the gap at about $80 billion per annum. And mainly, as Mark indicated earlier, coming from the rejections. So our focus has really been on the supply side, talking to the banks, understanding the constraints that they have in the market. And it also indicated that 40% of Africa's trade is intermediated in one form or the other. But the rejection rate for SMEs is as high as 40%. That is quite high. And we said, okay, as we launch our program, we have to find ways and means of bridging this gap, working with other MDBs, but also be more targeted in our interventions. But more recently, we discussed the issue of the demand side. So, okay, all these studies have focused on banks, trying to understand their perspective. But what about the firms themselves, the importers and exporters on the continent? What do they think are the major challenges, the pain points in trade finance? So in 2021, we launched a study. Of course, we can't cover all the countries, given the number of firms there are. So we decided to start off with Kenya and Tanzania in East Africa. But we believe the findings of the study could actually apply to most of Africa. And some are really startling. Of course, we surveyed 804 firms in the two countries, 402 in Kenya and 402 in Tanzania. And some of the results were a bit startling. First off, we of course had to understand trade itself in those countries. And coming from West Africa or other parts of Africa, what we saw in terms of the shift in the trade patterns itself, not from our study, but really looking at the data, was one thing that if you look at before independence, the 60s and 70s, most of Africa's trade was with Europe, then a bit in Asia. But what we found in East Africa was something we didn't believe that was the case. That UAE, for example, was in the top 5. In many instances, it was number 3 in Kenya, number 4 in Tanzania as trading partners. So you had India, China, UAE, and the US or Switzerland, depending on the country. And in Uganda, UAE was actually their top trading partner when you put exports and imports together. So quite a shift from what one would have expected. So that was a bit startling for us. Then we looked at the sort of instruments that firms use. And again, contrary to our views that it will be letters of credit, short-term revolving credit was by far the most used instrument by these firms. Less than 10% of exporters and 15% of importers reported letters of credit as the main source of trade financing. In terms of the cost of financing as well, this was quite significant. You look at basically overall, the cost of trade financing as a percentage of the value of transaction is 12% on average in these countries. 12% of the value of the transaction relates to the cost of financing. And the cost of LC financing was as high as 7%. So the cost of financing itself becomes a major challenge for firms in these countries. Then we also looked at women and say, okay, typically it is believed that women own businesses at a disadvantage when it comes to access to finance. How do they perform? How do they do in trade finance? One, we realized that they are no more riskier than men-owned businesses. The NPL ratio of women-owned businesses and men-owned businesses were almost the same. In terms of the cost of business or the cost of access to funding, it was also relatively the same. But what was important to note, though, was that women involved in trade finance tend to serve more markets and employ more people. This for us was very important. And we talk about financial inclusion. We do have a program within AFDB called the Affirmative Finance Action for Women in Africa, which is geared towards bringing more women into finance. So this was really highly compelling for us. But then we juxtaposed that data with what we had on banks in Kenya and Tanzania. So over the years, we have surveyed 58 banks, which is about 56% of all the banks in Tanzania and Kenya have been surveyed from 2011 to 2020. Now, in Kenya, for example, banks put the rejection rate at 8% overall. When we speak to the firms, they put that at 20%. So it is even possible that as we do our studies, focusing on the supply side, we may be underestimating the gap that we find in our various countries. We also spoke about the rejection. Why, your request rejected? Remember, I said overall in Africa for SMEs is 40%. In Kenya and Tanzania, it's less than that. For the entire market, about 20%. But when we asked the firms, why were your requests rejected? The first one was insufficient collateral. That was key for them, that they don't have the collateral. That banks also tell them they don't have enough foreign currency to pass around. When we speak with the banks from the surveys we've conducted, indeed, insufficient collateral was number 2, but weak creditworthiness of the firms was number 1, and number 3 were concerns around AML and KYC. The fourth one was FX. So foreign currency unavailability or limited availability and insufficient collateral indeed were spoken to by both groups, but the firms did not talk about their weak creditworthiness or the AML challenges. So perhaps the banks themselves need to communicate a bit more better with the firms so that there's a bit of synchrony in where the challenges are. So I can go on and on and on and explain what is going on and where the challenges are. Indeed, so many. But these are useful, they're important because our intervention instruments have to mirror the needs, the challenges in the markets faced by the firms and the banks. And unless we really do these studies to better understand where the needs are, our solutions may not be as effective as they can be.
Thank you, Lamin. And I want to top up on what Lamin has been saying because the AFDB has been the precursor. And the WTO and the IFC, as Makiko was saying in the earlier panel, took a deep dive in Africa. And so we selected ECOWAS, Nigeria, which is the biggest economy apart from South Africa in sub-Saharan Africa, Côte d'Ivoire, Ghana, and Senegal. And we actually surveyed all the banks. So IFC surveyed all the banks. There's about 100 banks. And we got like 95% response rate. And so what we learned there is very important. Remember what Lamin said. 40% of trade finance is covered, 40% of trade is covered by some kind of trade finance in Africa. We estimate that in the world it is between 60 and 70%, maybe up to 80% in most developed markets. So there's quite some way to go. But what we found in those Western African markets is that, the whole of Africa means also Northern Africa, the Maghreb, and South Africa, which has a financial market. So basically here the coverage is quite high. But if you go down to Sub-Saharan Africa, let's say Western Africa, here the coverage rate is only 25%. Right, 25% of trade, that is 42 billion out of 165 billion of trade is covered. Right? So why is 75% not covered? Well, there's the rejection rate. That means that those who ask, 25% of them are just simply rejected, right? So, and for the same reason as Lamin was saying, it's always coming up, lack of collateral or credit worthiness. Now, I'd like to make a comment of the two. Lack of collateral, it's always, for people who are in the business of trade finance, it's always surprising. The collateral in trade finance is the merchandise, right? The possibility to seize ex officio, go to the Tribunal of Commerce, ask for an order, you're not being paid, you can seize the merchandise, any receiver will resell it, right? This is UCP, this is ICC rules. In places where the rule of law applies, it works just like this, right? And despite the fact that default are very, very rare in trade finance. As we know, the default, average global default on a letter of credit is 0.5%. So how is it that people ask you for a second collateral, right? When the merchandise, even in Africa, you know, a good receiver will liquidate that merchandise and resell it, right? And so the bankers are telling you, well, because, you know, we don't have that much default indeed, but we cannot go to Tribunal of Commerce because either they're not functional or we cannot get rapid handover of the merchandise. So basically the habit has been to ask for that sort of systematic collateral. And sometimes it's just land collateral, which is very much in the agricultural unacceptable to firms, right? So there is a problem here with respect to collateral, and we're thinking about it, you know, alternatives. But the other thing is credit worthiness. It's not the real credit worthiness of firm that is actually at stake. It is the perception, it is the impossibility for banks to assess that credit worthiness. And here, what am I talking to you about this? Is because there are great opportunities for your fintechs to come in Africa and help. You know, whether you have fintechs that are able to analyze the payment cycles or the payment record of companies through telephone applications and so on, there is just at the present moment little capacity by local banks to be able to assert non-bank businesses, because often banks are not, often the businesses are not properly banked, right? So they may have, you know, telephone application, and there are very few fintechs that actually do that. There are a few in Kenya that are trying to expand, but the banks are at loss in terms of getting good bookkeeping, right? So the bookkeeping or credit record is hard to establish in Africa. Still, it doesn't mean that default is higher than in the rest of the world. Actually, statistics tell you the contrary. Default is not higher in Africa than anywhere else in the world on trade finance products. So it is a matter of perception of risk, and I think UAE banks are well positioned, given their experience, to operate in an environment where you have to assess and to reduce that, you know, the difference between the perception of risk, and bring eventually the capacity and the technological capacity to assess the risk of the customers and the banks that are taking, and bring also sometimes new products like supply chain finance products that are underdeveloped there. So I think that's the point, and that's what multilateral development banks are trying also to nurture in Africa, because a lot of them, the African Development Bank, the Afrexim Bank, the IFC are operating in Africa, trying to boost that local capacity, trying to reduce the risk perception that is very high from banks, to support the nascent sectors of exporters and importers in Africa. So having said that, I would like to turn to Khalid and ask him a couple of questions. Can you precisely give us some insight into your trade promotion activity, the Dubai Chamber's trade promotion activities, and the commitment to the continent?
Sure. Thank you, Mark. The Dubai Chamber's commitment to the continent actually started 10 years ago with opening our first office in the continent in Addis Ababa. We continued this commitment by expanding in Nairobi for our East Africa office, Ghana for Western Central Africa, and also Maputo office. This year, we're also again reaffirming our commitment towards the continent by opening our office in South Africa and Nigeria. So the continent for the Dubai Chamber of Commerce is a place that we are very much aware of its potential, and we are very much involved in creating the real value towards that potential that we aim at. International offices of Dubai Chamber, as my colleague Mohammed bin Sulaiman mentioned, has offices all over the world. So we are also there in South America. We're also there in Central Asia. We're expanding in Europe this year, Singapore, Indonesia. We've just got our license in Hong Kong. We're opening in Australia. So the expansion over here and the Dubai Global, led by the Dubai Chamber International, is very clear and very focused. But now we're here to talk about Africa. A lot of people always tell me that Africa has a lot of potential. I tell them, time for potential is over. It's no longer a potential game. If I tell you that we believe in the continent potential and we hope that it works, it's not a belief, it's a firm partnership. And we can see that very clearly with DP World moving to the continent. The latest acquisition of Imperial in South Africa is another indication of that. We are actually involved not only in the logistical move, but also in improving the railway system, investing money on the infrastructure. So there we are. We have a continent out of which 80% of its roads are not paved. So only 20% of roads in Africa are paved. 80% of those roads are not paved. And when we talk about roads that are not paved, that controls a lot how goods and services are moved. Life expectancies of your machinery, what kind of machinery I will run on these roads, maintenance, even cost of energy, something very, very expensive in the continent. And you wouldn't believe that 30% of the 20% roads that are paved in Africa are in South Africa, which is, again, another challenge. So we know that trade finance is a component that structures the financial risks, that gives you the ability, the comfort to do business. But at the end, all these goods have to be moved, all these goods have to be worked at. And at the Dubai Chambers, we look at this not with an eye of an observer, but with an eye of somebody who would actually pull their sleeves up, put the right people together, put the right components, look at the market, look at the opportunity. When we move goods from a certain place to the other, says, best people to do business over there will be people dealing in commodities like coffee, for example, because trucks carrying coffee will run on this road. Trucks carrying vegetables will never do this road because the road condition, 2-3 trips down that road will affect the cooling system of the trucks, and all of a sudden it's no longer feasible to do business. I'll give you another example, which I really love. Back in October 21st, 2019, DP World started their operation, their dry dock operation in Kigali, Rwanda. This was 2 months before COVID shut down the world. So they started their operation. They started with 2 huge warehouses constructed by Dubai-based companies. So Dubai-based company says, you're going to Africa, we're constructing our warehouses over there. We go there. This is the game that Dubai knows very well. We constructed, fixed, it's there, we're up and running. Each truck in Kigali at that time, the average truck would take 10 to 13 days to offload their goods. So you have 10 to 13 days to offload your goods in Kigali, Rwanda. If you're lucky, you'll do 3 clients, 3 shipments. DP World is there, they run the business. Now it takes 1 to 3 days. So if you're unlucky, you do 10 trips a month. That's helping people do business. And that's what we believe in. We don't only do Global Business Forum Africa and we talk about our dreams and our aspirations. We don't support functions like this, but we bring the think tanks and we bring the synergies and we bring the energy and we take all of this and we walk out with it. We try. And I tell you, a lot of the times attempts don't work, but at least we know that we have a direction. We know that we choose the right partners. And I tell you again, and I say it with utmost trust, our commitment to the continent is absolute.
Yes, thank you very much, Khalid. And I want to emphasize that a lot of the issues that are in Africa are practical issues, and they're solvable. I mean, you can solve them, right? And so, in our studies in Western Africa, what we realized is that we were able to calculate how much, and actually, you can replicate that in any region of the world, how much more trade you can have by having how much more trade finance. Right? So if you, for example, if you increase the 25% coverage I was saying in that region up to the African average level of 40%, so that's only a 15% increase in trade finance coverage of trade, then you would have 8%, so an increase of 15% would give you an 8% increase in trade every year. The trade finance gap is 14 billion. That would have essentially filled the trade finance gap. That would create, for 10 years, 140 billion in the region of extra trade. This is enormous opportunity. So we are telling the banks, the multilaterals will help you build capacity as much as Dubai is helping in the transport area. The trade cost in Africa, the average trade cost in sub-Saharan Africa, are 300% of the value of the merchandise. And finance, the overcost of finance, so relative to the international price, whether it's an LC, as Lamin was saying, or whether it's pre-shipment export finance, is about significantly higher for funded facilities, about 10% higher, right? So 10% is the extra cost you would pay. Now, of course, with this, a lot of exporters have a hard time being competitive, but once you start reducing the cost, and it is not impossible, then these exporters become extremely competitive. Isn't that right?
Absolutely. I mean, if you ship a car right now from Addis Ababa to Kinshasa, it will cost you $5,000 and this is pre-supply disturbance prices. I mean, I'm talking $5,000 before the supply chain disturbance that happened. So Addis Ababa to Kinshasa, $5,000. The same car from Addis Ababa to Tokyo, from Tokyo to Kinshasa, $1,800. This is, this is absolutely, I don't want to say ridiculous, but I'm saying ridiculous. But because it's ridiculous, here comes the chance. Look at Africa as a continent. It has 13 geographical layers of land. You got land that is full of timber, you got land that is cattle feed, you got land for agriculture, you got land for mining, you got ports, you got desert, you got mountains, you got different terrains, 13 terrains, different terrains in Africa. If you look at entire Asia, what, 4 or 5 terrains? And if you look at the active part of Asia, where most of the population is, we all grow rice, we all grow tea, but we've managed to do a lot of trade among each other. And now, having the famous Silk Road, $15 trillion economy is China, $5 trillion is Africa. Again, we don't believe in the potential. We're actually betting on the potential, right? So we know that, look at Dubai. Everybody says Dubai is a great city with wonderful roads. No, I say Dubai is great roads with wonderful city. So Dubai was built around great roads. Everything in Dubai, and people who have been here before 1985 understand that formula. Build the road and everything else around it will happen. And that's what we're committed in doing in Africa. That's one. 2, do the math. It's never wrong. You said yourself 300%. That's a lot. This, I'm not paying for anything except the logistic. The number of hand that touches this particular good and bring it over here. The world economy by 2050 will 2x. Africa's economy by 2050 will 30x. Right now, the Africa's contribution to the world GDP is 2 to 3%. By 2050, we're talking 14.5%. Where do you want to be on that bus? Do you want to have the first bus leaving early in the morning, reserving your seat in a continent, or you want to take the last bus sitting on the last seat? That bus is leaving, and we're all going to be on that bus. It's the only frontier left. It's the last hope. We're out of space, ladies and gentlemen, and Africa is our last hope. We have to do it right over there.
If you want to develop physical infrastructure, work to my colleague here from the Dubai Chamber. If you want to develop the financial infrastructure and invest in Africa with a certain level of security, the African Development Bank is open for business. They have a trade finance facilitation program. We've discussed the value of these programs in helping inclusion and link foreign banks to local banks. I highly recommend it. And by now, we will end this panel with a video from our colleague Gwen Mwaba from the African Development, from the Afrexim Bank, that has invested also a lot in the trade finance infrastructure. They're also providing guarantees. They're also providing a lot of comfort to correspondent banks that want to operate in Africa. So can we run the video?
Yeah, let's roll it, please, Habib. So here at the Global Trade Facilitation Summit, in Dubai, we're in the panel. We're Africa the last frontier, and Africa the last frontier, and I'm very pleased to have with me Gwen Mwaba, Director and Global Head, Trade Finance at Afrexim Bank. So, Gwen, you're very welcome to join us on the screen, but we're very sorry you're not here physically with us.
Thank you very much, Vince. I too am very sorry I couldn't be there in person, but thank you very much for accommodating the Afrexim Bank in today's conversation.
Okay, you're here for a reason. We want to hear views. So I have a few questions that I think will fit into the context of this session that's being led by our good friend Mark of the WTO. So I'll just get right at it. What are your views on how the persisting trade finance gap can be narrowed in Africa? Bluntly, can we really make progress with this problem?
Yeah, no, really important and topical question, Vince. I mean, the trade financing gap is something that development finance institutions such as Afrexim Bank need to remain concerned about. And in the context of Africa, we all know that SMEs are the key drivers of most African economies. And yet we see that SMEs continue to suffer from being the more highly rejected entities when it comes to accessing financing. I mean, if you look deeper into the data that makes up the trade financing gap, you know that it's largely made up of SMEs. This is because SMEs have the toughest time when it comes to accessing finance compared to larger corporate, and the rejection rates by banks when it comes to SMEs is disproportionately higher when compared to the rejection rate for corporates. And there's a number of reasons for this. SMEs, by their nature, are just deemed to be much riskier borrowers. And in some cases, there are issues around their ability to clear know your customer compliance policies and requirements. SMEs generally tend to lack collateral that they can pledge to secure their loan. Sometimes they don't have audited financial statements. So all of these elements tend to make it difficult for SMEs to access financing. So given the foregoing, DFIs such as Afrexim Bank have a key role to play because it's difficult for commercial banks to overcome some of these issues. So, and some of the things that DFIs can do include identifying alternative means of financing SMEs. And there are a few tools that can be used, financing solutions such as factoring, finance. By their nature, the structures are the more appealing for lenders to finance SMEs. I think DFIs also have a role to play through offering capacity building to SMEs.
Yeah, that's a really excellent summary of the problem and highlighting of what may be some solutions going forward. But I just want to delve a little bit deeper into what may be a cause or part of the cause of the problem. And being bluntly speaking, we know international banks continue to de-risk and we see them scaling back and exiting African markets, dare I say. So in this context, what role can a DFI such as Afrexim Bank play to lessen the impact of de-risking? Is there anything substantive that you can really do? Because this is a major problem.
You're absolutely right, Vince. It is a big problem. De-risking continues to be a problem, particularly for Africa. Afrexim Bank has just taken the position that we need to step in and help minimize the impact of de-risking, because the impact on the continent is huge. Countries companies cannot pay for essential supplies. So one of the things that Afreximbank has done is we set up a few years ago a letter of credit confirmation facility, and we are positioning ourselves to be the correspondent bank for African banks. Under this program, we're aiming to have 500 banks approved with letters of credit confirmation limits. We're currently at around 110 African banks already participating in the program. Cumulatively, every year we're doing just under $3 billion in LC confirmation for African banks to replace some of the and limits that have been, scaled back or cancelled by international banks. Now, in addition to this, we've also noted that some of the smaller countries particularly are having difficulties in making payments because KYC is simply too expensive for international banks to bear that cost, particularly where flows are very limited. So, countries like Sierra Leone, Liberia. So again, Afreximbank has set up a program to facilitate payments called AFPay. We help, African banks set up correspondent banking accounts with ourselves so that we can facilitate those payments on their behalf. So we hope that the combination of these actions will at least minimize the impact on the African continent when it comes to de-risking.
That's really encouraging to hear that Afreximbank is engaging at such a level. Final question, and it's something I'm really interested in, but I don't know a lot about it. But I know you do. And so I believe about 40 countries have ratified the African Continental Free Trade Agreement, AFCFTA, with far-reaching aspirations to reduce tariffs and open up individual markets in Africa. But I want to know what you think. Do you think this can really be a game changer in advancing trade between the countries in Africa, which we know is really at quite a low level?
Yes, absolutely, Vince. And intra-African trade is very, very topical for us at Afreximbank. It's the arrowhead of our strategy. And by way of update, we now actually have 44 countries that have ratified the AFCFTA.
Very good.
And significant progress continues to be made. There's no doubt that the AFCFTA is a game changer for the continent, and it will continue to create the Africa that we want, in line with the African Union Agenda 2063. The AFCFTA has created the world's largest free trade area since the creation of the World Trade Organization. And this measure is when you consider the number of participating states. So, when you look at Africa as a continent, it's a continent that offers a single market of 1.3 billion people. With a combined GDP of $3.4 trillion, which, if this works, will make it the 5th largest economy globally in terms of GDP. So, this large market that is being created by the AFCFTA will catalyze AFCFTA-led industrialization on the African continent. And this will facilitate development of regional value chains, reduce Africa's reliance on export of raw commodities outside of the continent. We firmly believe the AFCFTA will boost intra-African trade, and also it will promote trade in services as well as intra-African investments. And, a study by the World Bank has shown that AFCFTA represents a major opportunity for countries to boost growth, reduce poverty, broaden economic inclusion, and make African countries a lot more competitive. If it's fully implemented, the AFCFTA is expected to boost African regional income by around $450 billion. Yeah, and as a result of this, we expect to see a speed up of wage growth for women.
That's a wonderful story, and when I see this in the backdrop of the such a young population in Africa, and when I think then about that so much agricultural land in Africa is not currently being utilized, linking that into what you've just elaborated, and it's a very positive picture going forward, I believe. Challenges, but optimistic, I think.
You're absolutely right, Vince. And in closing on that last point around the youthful population and agricultural land being in abundance in Africa, we expect, the intra-African trade to boost mainly agri-food, production, particularly
Yes.
milk and dairy products, processed foods, cereals, and crops such as sugar. And on the industry side, we expect to see growth in wood and paper product industries, chemical industries, rubber, plastic, pharmaceutical products. So there's a whole raft of benefits that will, follow successful implementation of the AFCFTA. And of course, we can't leave out tourism and transport, which is very big for the African continent. And we'll see sort of a more moderate boost for energy and mining. The AFCFTA offers an opportunity for the continent.
Wonderful. And here in the UAE, we see us acting in a way as a bridge for African markets. And it's something we're in Dubai Chamber building, and it's something that they are dedicating a lot of resources to. So, Gwen, all your comments fit perfectly in the context of the debate, the discussion we're having here. So I think we'll go back to Mark and we'll continue. He'll continue with the rest of the session. And thank you so much for joining us, not physically, but virtually. Greatly appreciated. Thank you, Gwen.
It's been a pleasure. Thank you very much.
Thank you very much.
Vincent,
ICC UAE makes it possible.
And thank you for Khalid, and thank you for Lamin. I hope we have convinced you.
You don't get away yet, Mark. We've had just a few comments and one question. Actually, the first question, I think it's a comment, but it's for Khalid. Just someone asked them, where can we catch this bus to Africa? Okay, you mentioned the bus to Africa is departing, so somebody here wants to know, where can they catch the bus?
It starts over here, by the way.
It starts in Dubai Chamber, just outside.
I'll be standing over here. I'll be happy to hand over my business card to you, and we'll go from there. I'll be driving the bus personally.
You'll be driving the bus. And the second comment is actually says Dr. Aban of the WTO is absolutely right. Trade finance is like microfinance. When the finance is your lifeline, that you won't default. So that's kind of an interesting concept as well. I hadn't borne actually in mind. And then we're nearly finished. Just a question for you, Lamin, as it came in. Some of the best payment technology is now coming out of Africa, okay? And it just happened, can the African Development Bank cover extended payment terms under open account? And I guess the answer is yes, or in particular. Would you like to respond to that? Or?
Yes, indeed. I mean, I think a lot of work is going on in that area to see how we can extend the terms of these facilities. The study we did in Kenya, one of the reasons why firms have in managing or issues in managing their trade finance is actually the short time they have to pay through the banks. So basically helping them to elongate that would resolve the issue of the NPLs that they have. In Kenya, it's a bit high, and when you ask them, they're telling you that, that the time to repay is very, very short. So the banks are able to help, basically, AFDB and others are able to help provide guarantees that will help cover the back end of the transactions. So with the supply chain finance of, facility solutions that we're talking about now, indeed, we are open for business. We are open to support, corporates and banks in the continent to have these alternative sources of financing being brought to bear to reduce the gap on the continent.
Wonderful answer. And could we give this panel a big round of applause? I think it was inspirational, encouraging, and also very enjoyable. It was really entertaining as well. So thank you very, very much. So we'll move on with the program, and thank you very much. And thank you, Mark. That was great. So, dear friends, we're now going to come bring the radar in a little bit tighter, and we're coming back to the United Arab Emirates. And I'm really looking forward to this next presentation. And we're going to be looking at the UAE Banks Federation, enabling the UAE as a trade finance hub. And well, as we know from what we've heard already in the morning, the UAE is already a logistics hub. It's already a trade hub, and it's already a trade finance hub. So I'm going to call the Director General of the UAE Banks Federation, Jamal Saleh. Director General, please, Jamal, join us on the stage. Thank you. And actually, we're getting so many comments.
Thank you, Vincent. Thank you.
We're getting so many comments coming in on the chat. I'll share more with you later on, but that'll be later. Thank you.
Hi, good afternoon. For those who don't know me, my name is Jamal Saleh. I'm the Director General of UAE Banks Federation. For anyone who does not know what UAE Banks Federation is, you can think of us as all the banks operating in the UAE. We have 28 technical committees made from those 58 banks who attend to all the aspects of banking, some of which is trade finance. So we have specialized committees comprising all the large banks, the experts in the field in trade finance sit together to deliberate solutions for all of you and for trade finance. So I wanted to tell you a little about the role that we play in facilitating for the UAE to become the trade finance hub. We are working on several similar initiatives to position the UAE as a leading hub in other disciplines, but trade finance is definitely one of the most important because we know the UAE, especially Dubai, has always been a trade hub. So I'll try to explain to you what we at UBF are doing about it. But first, just to put ourselves in the context, we all know what we have seen over the last 3 years. It's exactly 3 years, actually. I remember on this day when the last airplane arrived at 12 midnight, and after that, all international flights were stopped, and we were told to stay home. And we got worried that there will be now a run on supermarkets and food and shortages and what have you. And the best example that I keep thinking of is what our leader said in Arabic, for those of you who speak Arabic, when he said, "La tshilun ham," which meant, "Don't you worry about a thing." And it actually proved to be exactly that, because we did not feel the shortage. Trade and trade finance continued, at least locally. So now we are getting out of it, but we're seeing geopolitical instabilities that are redrawing the map, and we're seeing big fluctuations in commodity prices. Now that has somewhat positioned us already at an advantage that we just need to know how to foster forward. If we look at the global picture and how it ties with us here, trade finance, I'm told, is in excess of 20 trillion. Of course, commodity is a big part of that. But most of the players in trade finance would like to see a digital form of it. And that's exactly what we are working on. The digitization of trade and trade finance. I can tell you so many things about what we are doing to attend to that, especially that the UAE has said that as a strategic objective, the country would like to have 20% of its revenue coming from digital economy, from digital channels. That's 1/5, which is a huge percentage to target, but I know that it will be done. Now, how is the UAE now, and what's the role that the UAE banks will be playing? All in all, the UAE has been digitizing itself. I don't know if you have seen the video of Sheikh Mohammed years ago saying that I want the service that every resident may need from the government and the government departments to be done electronically, and to be done on your mobile. And now we have reached that where Dubai government has issued recently the last paper. So the whole thing has moved totally digitally. So the UAE is digitizing from end to end. Also, work is done always, including with us, in a multi-stakeholder way to make sure that nothing is left out, no stone is unturned, and nothing falls between the cracks. If I can give you an example only of what I mean by multi-stakeholder work, we as a federation, we do regulation consultations with the concerned authorities to make sure that any regulation coming out will be aligned with the status quo and it will attend to the objective. In 2022, we did 83 regulatory consultations. I don't think anyone knows that there was 83 regulations that have come out in 2022. People would know about maybe 5 of them. In fact, 83 came out, and all 83 of them were consulted with UBF, as well as all the other stakeholders, the regulatory system, the concerned ministries, the banks, of course, UBF, as well as the highest level of the endorsement. So nothing is done in silos. Everything we do is in multi-stakeholder, and we pretty much believe that going forward, demand for commodities will continue, consumption will continue, and therefore the number that we have seen, the 20 trillion, will only go up. So how can we put the UAE banks now in the picture, and what have we done? I said that the whole country is digitizing, but look at how much digitization banks are doing. Last year we spent 3.7 billion on digitization of services. Our member banks spent 3.7 billion to digitize the services that they are offering. We are also attending to the digitization of trade finance services. I can give you an example that you have always faced. I don't know if we have anyone from UTC. We built a platform between our member banks. If you would only look at the benefit that you get from having the ability to validate your documents between what's at the bank and what's at the port, to be able to identify if there's a forged document, if there's a duplicate document, and so forth in real time. I remember when, before this digitization, there was no way for you to do this apart from starting to call, hoping that you will find someone to talk to make sure that this digitization works. We actually appointed one person at every bank. And we gave the list of those individuals from each bank with their mobiles, emails, home phone number, etc., etc. We gave that list to all the concerned providers, you know, the JAVSA, ports, free zone, name it. So that you have the digitization in place, but you also have a nominated person who will take your phone call immediately to answer. So that's part of the digitization that we use. I don't need to explain to you the banking products that UAE banks have for trade finance, some of which don't exist anywhere else on earth. They were designed for Dubai or UAE trade. So there's a whole range of products that you can use at our member banks, and hopefully all of them soon all will become digital. All our members have, and stakeholders, have a very large network of global partners in every country you can think of. Even the chamber itself has, I think, 16 branches. Where's Ali? The Dubai Chamber of Commerce has, I think, 15 other branches in 15 countries, plus this one, so 16. And our infrastructure and our regulatory system that we have developed for both onshore and offshore is best in class. So where does all that put us? Between the infrastructure and everything I have mentioned, everything that we are doing with all our partners, I think we will be having the opportunity for the UAE definitely to be the hub for trade finance. And one thing that I cannot stop thinking of is the location of the UAE. If we go back to the 1980s, Dubai thought of setting up an airline, and the idea sounded weird at that time. And it started with one airplane rented from, I think, Pakistan Airways. And later it was purchased for 10 million. So it was only one airplane making 2 trips a day. If I remember, one to Pakistan, one to India. And everyone thought, why would you do that? You have airlines that can serve Dubai. And Dubai said that I have a unique location. I can be the link between East and West, between Asia and Africa, the African corridor that we have, the East-West corridor that we have built. So at that time, the idea of having an airline sounded strange, but look at it now, with Dubai Airport becoming, I believe now it's the #1 in passenger, 100 million, well, and Emirates winning the #1 airline and coming very close now to being the #1 size-wise. I can already see that happening with trade finance. Our banks are ready for it. We are ready to support our banks and all of you to achieve that. Thank you so much.
Thank you very much, Jamal. But before you go, just 1 or 2 comments that came in on the chat. One said, you're absolutely correct. The potential for air freight, especially into Central Asia, is just enormous through Dubai. That's just a comment. And then there was a question, any update or plans regarding the digitalization of guarantees for trade-based transactions?
Yes. We work heavily with ICC. We also work heavily with SWIFT. We actually have SWIFT in the UAE under UBF. I'm the chairman of SWIFT at the same time. We wanted, with ICC, to digitize guarantees, but we faced an issue in the variation with UCP 458 and 526 and what have you. And the solution that we were able to arrive at was URDG 758, is it? 758?
Yes.
See, Vince is the school when it comes to these things. URDG 758, to make sure that we are fully adhering to the text format of 758. And the meeting to agree on that and endorse it is tomorrow at 10 in the morning. Okay? So hopefully we will get that through, and we will then be able, because when you say you want to digitize Vince, you cannot digitize anything that varies. It has to be a standardized, let's use the word template. So we need to get to that. Along with that, because you have to look at the whole cycle, it's not only the guarantees, it's also the communication of the guarantee, it's the payment of the guarantee. So now we started with 222, and this morning our first bank has sent a communication that it has now moved fully to 122, which is fab. They sent an email to all customers saying that we are now fully ISO 222 for SWIFT messaging. The trial run was March 20th, 2023, but you have until 2025 to move fully. And our banks are ready 5 days before the trial run.
That's a wonderful response. It has been really great working with the UAE Bank Federation. I must say our debate discussions have always been open, a little bit of lots of agreement, occasionally a little bit of disagreement, and moving forward. And the implementation of the URDG 758 is a big step forward in simplifying and actually implementing digital guarantees. We'll continue to have a dialogue on the wording, as you said, the template that may be used going forward, and that will continue. So, Jamal, thank you so much. Any question from the audience, just in case there's a question from the audience? They've all been coming in online. Well, I think you've answered all the questions. Could we give Jamal a good round of applause, please? Thank you. Really wonderful, really wonderful. So just to tell you what's going to happen next, on time, every time, but we're actually ahead of time by about 5 minutes. So let me give you the logistics. We are now going for lunch, okay? Wow, you look so happy when I said that, okay? We are now going for lunch, but how do you go for lunch? Here are the logistics. Well, you go out these doors, and you go back down to the ground floor again, and go out the front door, okay? Okay, I'm not going to tell you you have to buy your own lunch. That's not our style here, okay? So you go out the front door, and when you go out the front door, my colleagues will be there to kind of greet you and guide you. And our lunch is in the Sheraton, which is just a 4-minute walk from the front door outside. You go out the front door, you go left, it's a 4-minute walk, but my friends are to guide you. And when you go in the front door of the Sheraton, you again turn left. So it's left and left and left again, and you can't miss it. So we're going for lunch now, but don't sit. Yeah, sit. Okay, that's okay. Okay, we're going for lunch now, but we'll be back at 2 o'clock. And when we come back at 2 o'clock, it's a really exciting program because we're looking at what Stephen Beck mentioned earlier on. We're looking at deep tier trade, supply chain, finance, the corporate perspective. So we're going to have corporate treasurers. We're shifting from the bankers, the development bankers, to the customers, okay? And after that, then we have 2 really exciting case studies, one from a bank and one from a corporate on implementing supply chain finance programs in emerging markets. So that's going to be exciting. Then we'll have a networking break, and then we're going to move on to trade transformation through technology. And we'll be bringing up some of the points I raised in this session. So looking forward to seeing you. We try and be back at 2 o'clock, so we start sharp at 2 o'clock and keep on time. And you can get up now, okay, and go and have your lunch. So enjoy your lunch and see you at 2 o'clock. Thank you. Welcome back, everyone, and please come into the auditorium, the beautiful auditorium in Dubai Chambers, and take your seats. And please come forward, because I'm promising you that this is really going to be a very engaging session. In the morning, you heard a lot of people talk about supply chain finance. And we even heard mention of deep-tier supply chain finance. But you know, all morning we've been hearing from, it's either bankers, which is great, or development bankers, which may be even better. But now we're going the other side of the coin. So we'll be looking at the corporate perspective in supply chain finance, how they manage it, how they implement it, how they run it, and what their expectations are from the banking sector. This will be the first portion, our first component of a two-component session. And the second one, we will be actually looking at, dare I say, case studies, or I might call it workshop or simulation, whatever word you like, but it'll be practical from the corporate perspective and also from the bankers, or from the bankers and the corporate. I think that's the way we're going to run it. So we'll be starting in about 30 seconds, but I need to ask you a very important question. I need to ask you a very important question. How are you all feeling after lunch? Yeah? Yeah, I seem like me, okay. Well, I guarantee you that's going to change in a few minutes. That's going to change fundamentally. And as we saw, we're getting a lot of comments coming in on the chat from our virtual participants, you know, and there was one, at last, everyone commented about our wonderful speakers all morning, but no one said anything about me. I was a little bit broken-hearted, you can imagine, you know. But eventually, there was one comment, okay, and this comment came from Kyrgyzstan, and the comment said, Vincent, I haven't seen you in 20 years, but you haven't changed a bit. Now, I'd just like to address this question and tell you I have changed so much you cannot believe. I've got much better, okay? Just be sure I got much, much better. It's true. You don't seem to agree with it, Dr. Satish, so you have me worried there, okay? So now we're going to get back to business, and we're moving forward with our supply chain finance, and I'm going to ask the moderator and his panel to join us on stage. So Wayne Mills, Atom Advisory, join us on stage with your panelists. Come on up, everyone. This is all very relaxed.
Thank you, sir. Cheers. Thank you. Two people coming in, but I think we'll get going. Right, good afternoon, everyone. Thanks, Vin. Delighted to be moderating this panel on supply chain finance. And as Vin said, my name is Wayne Mills. I'm Managing Director at Atom Advisory. I left banking after about 30 years at the end of last year, set up Atom, and we provide training and advice to banks, non-banks, and corporates on all things related to trade, supply chain, and receivables. As Vin said, after lunch is always not a great slot at any conference, so I won't ask you all to stand up and clap your hands, but I do promise to keep you engaged with informing you, educating you, and challenging you. There's going to be some provocative questions deliberately to draw out a response from the audience, from the panel, but we will have Q&A as well from the audience, so very keen to promote some debate and have a discussion. And as somebody said this morning, you know, there's nothing quite like somebody disagreeing in the right way to just get some lively discussion. So that's our hope. I know what we're going to talk about, so I can give you a guarantee it will be worth your while. You will leave here with something useful that you can implement in your own businesses. So hope you enjoy it. 3 objectives. Number 1, first of all, to explore opportunities and challenges around supply chain finance, setting them up, running them and expanding them. Secondly, if we think about supply chain finance as a working capital optimization tool, how attractive is it really from a corporate treasurer's point of view, especially in an environment of raising interest rates? Also, we'll explore the question, does it actually make you lazy? So we'll come back to that. And thirdly, we will go into deep tier. Talked about it a lot. It's increasingly common but we'll look at it from the point of view of can it help to build resilient physical and financial supply chains, but also explore the motivations from a large corporate, an anchor corporate who has access to good liquidity in banking capital markets. Is there enough of a driver for them to actually invest time and effort into deep tier? So again, we'll try and draw out a really realistic, honest view on that. So with that, let's get going. So if I can ask for a short introduction from each of our panelists, starting with Gianluca.
Good afternoon to everybody. My name is Gianluca. I'm the Group Treasury for Aldara Holding, a company that operates in the agricultural space. It's been 25 years that I have a passion for treasury, and I'm sure today we'll do all our best to have you passionate and to look into the details of the supply chain financing.
Stanley?
This is Stanley, part of General Electric. I represent the treasury function here in the region. I wear multiple hats, and one of the hats which I wear is to support our supply chain finance business in terms of our interaction with banks and FIs for the entire group. So I do that out of this part of the world, and hence the context to supply chain.
Hi, everybody. This is my first time here, so a lovely auditorium and great to see all of you. My name is Rahul Daswani. I'm based out of Dubai. I've had like 20 years of experience now in corporate treasury and financing, pretty much in emerging markets, Middle East, Africa, India, APAC, and in the technology sector. So I worked for Microsoft and Nokia. So, happy to share, my views on how some of these things play out.
Excellent, thank you. So, as you can see, really experienced panel. So hopefully we're going to get some really good content. I'm not going to make it too easy for them. So, and likewise, if you think about any questions you want to ask, please do likewise. So let's start with the broad context. Supply chain finance, as an industry, we suffer with lack of consistency of taxonomy. So from a broad contextual point of view, perhaps starting with Stanley, does supply chain finance in any of its forms, form something that you see as something important and growing in your business in 2023?
Great question. And practically speaking, the last few years, supply chain finance has been all about resilience for us, to help support our suppliers and probably their suppliers too. In the turbulent times, and especially with rising interest rates, we're seeing value for our suppliers and hence the onboarding piece. Now, just from a GE standpoint, the way we look at supply chain finances, we are very cognizant of the reporting requirements and so on. So we typically construct our program in a manner where I appoint a paying agent, and then what they do with my supplier is of no concern to me. Okay, so we do that at an extreme arm's length, and hence penetration for us on newer and broader suppliers would be if I'm opening up a new market, if I'm opening up a new manufacturing site, it's not about trying to optimize working capital. So that is obviously a result of what I do, but my core objective is resilience for my suppliers. So yes, 2023 is going to be important with what we are seeing in the market, and especially if we can go one more layer lower, that's what we are aiming to go this year too.
Okay, thank you. So just picking up on that point, and Rahul, perhaps chip in with your thoughts. Rising interest rates, I think we're not quite peaked yet if we listen to some of the major markets. Your thoughts in terms of the relative attractiveness in that rising interest rate market of SCF?
Yeah, so I think, in my view, there have been folks who've talked about that, rising interest rates will mean, supply chain finance programs are not going to be relevant. I don't think that's an accurate representation because, I've been, as I said, working many years and interest rates used to be higher in the past also. And, supply chain finance programs were relevant then. I think it will continue to stay relevant in the future. And I think the rationale for that is one, as Stanley said, that you have to kind of think about it, why corporates actually run supply chain finance programs. So there are one set of corporates, like Stanley said, whose objective is to bring about resilience in the supply chain, which effectively means they want to make sure that suppliers are kind of tied out, either from a capacity, perspective or from a loyalty perspective. So, even in an increasing interest rate environment, that will still continue to be relevant. But then there are other folks, who I know, for example, in one of my previous companies, we used to offer kind of a discount, for getting paid earlier, for the supplier to be paid earlier. And then that discount is still much more higher than the interest cost, even in a rising interest rate situation right now, unless of course the interest rates start to cross beyond 12%, then, situation may be different. So I think we are still not there yet.
Okay, thank you. Okay, so look, we have corporate treasurers. Over the years, I've spoken to a lot of treasurers who always tell me it's a bit of a thankless task, and there's always somebody who's not happy with what they're doing. So in terms of working capital optimization, and Gianluca, if you can perhaps pick this one up, lots of tools at your disposal to optimize your working capital cycle. There is a point, I think, around how attractive is supply chain finance, relatively speaking, against other options at your disposal. And also picking up on the point, if you have a program in place, is there a risk it makes you lazy?
Very good question. For my experience, and I'm talking about the last 8 years in the company in which I operate, I can tell you that we are living in a completely different environment, right? So before there were negative interest rates, so everybody was jumping on the supply chain financing solution and everybody was becoming lazy. Now, even though you have done already your job in trying to optimize your working capital in the recent past, with such a level of interest rates, you are requested to do it twice, just to make sure that you have done whatever it takes, using Mario Draghi quotes, to make sure that before going external in leveraging and trying to unlock cash that is stuck in your working capital, you have done whatever it takes in your optimization. For what I've seen before, there was much more risk to become lazy in going external with the supply chain financing solutions rather than optimizing internally. Today, this risk is still there because we are always talking about the margin. So it depends where we stay. Is your company in a situation that is adding value to your suppliers by doing the supply chain financing program, or is a mix of things, including but not limited to the benefit that you have in your ratio? Where do you stay? This is really, really important. In our case, it was used as an instrument to retain the supplier to join the program per se, and the margin that they were paying before due to their credit rating is still the same. Now, it has been improved because they have been able to join a particular program with us. But one more time, the laziness risk is still there inside your organization, especially when you have already an up and running program, because it seems too difficult to relook into this, maybe dismantle a little bit and check if you can do it something that is out of the comfort zone of the treasurer. Sometimes not all the treasurer are involved in talking with counterparties that are external, such as customers and suppliers, because this is fully dedicated to procurement or salespeople. But the reality is that we don't want to be in the middle of everything, but we can really add value. And the supply chain financing should be really something that will unlock after having completed all the real stages that are necessary to be done within the organization. So now, more and more, I'm happy that this is happening, but the space for supply chain financing laziness is still there.
Yeah, I think just to add to what Luca, you mentioned is, there is a need for us as treasurers to also kind of hold back, okay, because SCF seems to be a great kill, okay, to be able to optimize working capital. So, and any banking discussion you have, banks are just coming to, and this is the first product they want to, work with you on, right? And G being G, I'm sure, I know the reason why as well is, so there is a temptation as treasurers to start looking at solving for an issue which is not there. Okay, so that is also something which we are personally cognizant of. The first leg really, supply chain finance eventually is the last leg of the resilience creation chapter. It's, we're looking at nearshoring, looking at other options to to create resilience, because the definition of what we need in terms of resilience has changed post-COVID. And hence SCF, however tempted I am to look at getting on and creating a solution with my banking partners, we need to hold back as treasurers as well.
No, absolutely. And I think to that point, and Gianluca's previous point, as bankers, and I've had situations, you know, where we're trying to create new products and propositions, the importance of co-creation with clients to draw out some of this feedback, because actually from a propositional point of view, it can look really smart, but actually some of these softer issues, you know, for these treasurers, you know, are actually possibly more important than some of the mechanical issues. The other point as well, Gianluca, on your point around collaboration and cooperation with stakeholders, I would say as well it's internal. You know, I'm sure we've all had situations where Treasury and Finance have been engaged and completely on board with a proposal, but then procurement and IT come along and say, well, actually, we can't implement that. So I think that horizontal and vertical collaboration is pretty key to make these things work. Okay, so let's move on then to thinking about growth and the enablers. And Rahul, perhaps I can come to you then. Simply, I mean, what needs to happen to enable growth in this market then?
Yeah, I mean, I think payables financing, you know, is potentially starting to reach a point where, you know, it will start to plateau out, you know, flat out. Because, you know, as a product, it has been kind of well known, well understood, it has been tried. So I would say, I again go back, you know, in this kind of concept that what is payables for somebody is actually receivable for somebody else. And I think really if, you know, some of the banks can put some kind of brain power behind these subjects to kind of flip it over and find a way to create solutions around receivable financing, that will actually, you know, kind of bring about, you know, the next level of growth, because, you know, that just kind of adds another layer or feature around it. Because otherwise, I do think that the market may start to plateau out on this subject, at least for large corporates, yeah.
Okay, okay. And any other thoughts from you chaps on that?
Yeah, look, totally in agreement with Rahul. However, this part of the world is a little different. Large corporates have been tapped out, okay, to a great extent. But there is a segment below the large corporate. I'm not talking about the MMEs, but just somewhere between the large corporate and the MME bucket, which is still open to be tapped. Okay, that's one aspect. But from a large corporate perspective, what are my CTQs, right? You know, today, I see this proposition also linking very well with the ESG component. And I think it's easily measurable as well. So from my perspective, if I have to look at how this can grow further, bringing in that leg is important. I have had banks, every bank has a solution, okay, on paper. But when you're talking about, you know, actually implementing it, what would it really mean for my supplier? What would it really mean for me as GE? It gets gray. So that's an area which will be of focus. And the second leg would be to try and see how can I penetrate, and that probably goes to the next leg of the discussion on deeper. You know, how can we go deeper, again, to create resilience more than anything else?
Yeah, absolutely. Yeah, and we're going to delve into deep tier shortly. Okay, so the final point then, I suppose, around facilitation, growth, enablers, etc., is one of technology. You know, some brilliant work being done by technology service providers and platforms. So that, I think, is really coming into its own. So, Stanley, your thoughts, are there any gaps that the technology service providers, and increasingly we're seeing collaborations with FIs and technology service providers, which I think is necessary. Are there still any gaps that you see from a corporate perspective that, you know, need to be filled?
There are two legs of technology, right? There is one from a solution perspective, what the bank brings to the table, maybe individually or maybe in partnership with the fintech, okay? That's something which we are seeing. The other leg is implementing something like this internally is an effort from a technology perspective. Also, when you have multiple ERPs, multiple lines of business, it just gets very complex. Now, that leg of trying to solve for a corporate's technology integration is not something which I see banks tapping into or trying to at least provide a solution for that. It would be useful. I've seen test cases. I've seen some fintechs talk about, that we are Oracle compatible, we are SAP compatible, and so on. But when you look at the nuts and bolts of how that would work, we are not seeing that as feasible as what it would sound on paper again. So technology from a solution driver standpoint is there, and it's improved fantastically, especially also on the KYC standpoint. And I think that's another leg which is been a key enabler. But linking it back to technology within the company is key. Cash management at one point of time used to be a product which was extremely sticky. Once you launch it with a particular bank, you don't move because the cost of moving is extremely difficult. Supply chain finance is that right now. Okay, so you do it with one bank, one provider, you're not going to move for life. So that effort and that partnership to get technology on board has to be mutual. I don't see that happening.
Absolutely. Any other thoughts?
Well, from my end, if I can add, I think in this part of the world, we need to be also honest that the corporates are not at the level of technology that are they're trying to catch the other regions. And I'm sure that some of you will be in a situation where the level of IT infrastructure or the system that you have should be evolved or in process of being a part of a transformation. And this is also a bottleneck when it comes to implementing a program where the bank is giving you in combination with a fintech because you don't feel ready, number one. And number two, you said something very important, that you're going for a wedding.
Precisely.
So you want to make sure that it works very well. Good things take time.
Rahul?
Yeah, so if you think about technology around an SCA program, there's really three components to it, the way I think about it. One is, the whole internal approval process of sending a transaction over. Then there is the part of the documentation process of how a transaction gets done. And the third part is the settlement and reporting. If you kind of break it out, it's really three parts. The internal approval process, in fact, is a little bit easier to resolve. There are kind of now tools in the industry, and there are tools companies can kind of make themselves also. The transactional process, unfortunately, right now seems to be in multiple streams because the documentation, of a same transaction in a same country may kind of run through even the different instruments. So I don't think that's an easy solution that in a single bank can actually solve. It's a tricky one, and that's why you have these kind of trade conferences all the time and trying to figure that out. But I think the third part, which I think Stanley mentioned, is also a very critical element, is how do you kind of make the settlement and reporting process to be simple so that at least the first leg and the third leg is fairly automated, and the second you find a way to kind of deal with it, kind of manually. So I think, banks should kind of start thinking about it from that end. And then if they can put out a product which kind of solves for the first and the third, that by itself will be a huge advantage, to offer to clients.
Absolutely. Okay. All right. Thank you. Look, conscious of time, and I'm going to mix it up a bit now, actually, so I hope these guys don't mind, but we'll do this live. In response to this morning's session was really insightful for me, actually. The multilateral bank session in particular, the fantastic work they're doing, and the comments around supply chain finance, and in particular deep tier. I would argue, as a practitioner, the supply chain finance has failed in its objective 100% almost around financial inclusion, because it's absolutely not reaching the SMEs to whom it was initially intended to reach into. So with that backdrop, and I said it'd be a bit provocative, so let me just give you 3 anchor points. So let's start talking about deep tier. On the face of it, we've got something which, as an opportunity, it can address financial inclusion, it can address ESG, and it can address supply chain resilience. So I guess, what isn't it? And we've heard about challenges, and I'm keen we come up with solutions in this session as well. But also keen that we have a very realistic view from corporate. So 3 things to think about. As an anchor corporate, good access to liquidity, it has to center around that party. and what are the drivers for that party? So balance sheets, working capital optimization, supply chain resilience. If balance sheet reporting requirements are coming under more scrutiny and are becoming more cumbersome, is that actually a reason not to look at supply chain finance? Working capital optimization, the relative attractiveness of supply chain finance to other tools, is that a reason not to look at it? And supply chain resilience, post-COVID, nearshoring, onshoring, are corporates now looking at building in resilience to their supply chains in ways which mean they don't have to look at supply chain finance? So I guess the open question to the panel is there enough of an incentive as large, well-funded corporates to even look at this? So I don't know who wants to go first, and you can thank me afterwards. Gianluca.
I can go for it. Well, in our case, I would say yes. We see the additional value that can be added to various level down, so down on the road in our ecosystem. We have seen the beauty that can be achieved, as we say, despite the growing interest rates. The difficulty that we have seen is more in relation to how to do that. The benefits that includes also the visibility on the entire supply chain are there, as you mentioned, part of the main 3 key factors. But the admin job in relation to that is significant. There should be person dedicated. We are looking into this as we speak. So you are going to further level downs that usually today you don't do that. In our agricultural business, we are lucky that this is not happening all the times, because we always try to go to the deepest level, meaning to operate with the farmers that are in various parts of the world. But in many occasions, this is not possible, and therefore it's really beneficial to our group to make sure that this program is extended, and the benefits are for the ones that are literally doing the most important part of the job. So I see still the incentive, a great incentive to look into this at any level, because there is a comprehensive goal for the anchor corporates and also the partners that are part of the ecosystem on a regular basis. This is what I've seen, and that's why we are looking into this at this stage, to make sure that we unlock the potential for them, and we have the indirect benefit as well.
Okay, and I'd be interested to draw out any sector-specific differences in this discussion as well. So Stanley, do you want to chip in?
No, absolutely. So you mentioned 3 points. You spoke about specifically balance sheet, working capital, and SCF resilience. So to be extremely transparent here, the balance sheet treatment and the accounting guidance and so on, we are very cognizant and we are watching that space extremely closely. We see that the bodies have now understood what SCF means, and we see specific guidance. We don't want to rock the boat too much at this point of time, because we're just starting to. We've been complying with all of them much in advance, but we're seeing as and when the bodies are understanding what SCF does, we envisage that there will be a framework of accounting and guidances which will further evolve. So do we want to step onto this bandwagon now and then again look at modifying something which we're supposed to be doing? Not actually. So that is one negative for us. From a working capital standpoint, the moment my tier 1 supplier is tackled, I'm done from a working capital perspective, right? I don't have to further go deeper just because that layer itself, it takes care of most of what I want to do. There is another barrier for me here, is the whole aspect of the legal framework of how this would operate. And that for me is a larger concern, because when I look at documents which banks bring to us to table for going deep tier, jurisdictional aspects in terms of how you would look at it, cross-border, etc., extremely complex. And then if you've got to digitize the payment obligation further down, that is then another complex element in terms of how would you actually do that, under what framework would you do that. I don't see a common standard And do I want to spend too much gray matter on this? Not really. So if I've got to, if for me the core motivation again goes back to resilience and going deeper in terms of trying to figure how can I get greater ESG marks to be able to go deeper and also push governance and social responsibility down to that nth level. There is also one other concern, and this is just me talking here, is my payment obligation. I'm pretty concerned about where that eventually lands. I don't want it to land to support a supplier who I would not deal with in the first place. Okay, so when I'm talking about deep tier, I want to have visibility to how deep that can go to. Maybe I just stick to tier 2 because that is something which I'm pretty concerned about as well. So these elements here just make it very complex in terms of how deep can I go. When I talk to private banks or the multinational banks, they hear my pain and I don't think they want to walk the path with me on that pain very clearly. And I think that's where there is a need for MDBs to come in and participate and support them to be able to walk that path with me. I'm not seeing too much joy when I talk to them about this currently.
And being in a bank for many years, we are always sympathetic to your plight. It's always understood. Okay, and so on, Rahul,
so we
perhaps.
do have a different opinion.
Yeah, agree.
Just to be clear.
Absolutely.
So the other thing then, Rahul, perhaps is your views, but whether do we need to think about this? We're talking really payables, buyer-led programs, thinking about this from a receivables point of view and seller-led, perhaps you can cover something on that?
Yeah, so I think it's actually quite a big subject, and we may need an entire kind of half an hour on this, but I'll try to summarize what my thinking is and what my learnings have been on this. So one, I think, let's go back to what Gianluca was saying, that, as Sunny was saying, it's very important to think about the second tier, third tier, but it is beyond the finance objective in some ways. You have to start thinking about, is your supply chain resilient? And more than that, in some ways, it starts to step into this corporate social responsibility also. What is the organization overall sustainable impact, in the broader, in the broader economic world. And we see now in the CFO's office, there are now new teams being created, new units being created, who are, technically not finance, but they are supporting goals like, racial equity, they are supporting goals like housing, social responsibility. They are part of the finance group. So finance people are getting new, new opportunities to work in that space. So I think some of this starts to fall in that area, this tier 2, because it's really trying to understand, are we building a sustainable, capability for the organization to function? And the reason it falls under finance is nobody else is willing to take that much of a responsibility. And anybody who's worked with sales organizations understand what I mean by that. So I think I will leave at that. I think the bigger issue on the SCF, as Stanley kind of talked about, was this reporting. What is this reporting issue? And at least on the US GAAP side, it's starting to become quite worrisome, I would say. And, I would actually be more worried about that than the interest rate. So I would leave it at that at this point of time. Coming back to tier 2, I think what is fascinating about tier 2, I think the solution around tier 2 and how you track around that actually lies in some kind of a blockchain or even so-called crypto technology. We don't fully know how to address that because, if you want to go, as Stanley was saying, to tier 2, tier 3, tier 4, there needs to be a mechanism where all of that data can come in, but it can come in some kind of a restricted access to a broader organization. Because as a company, we may not actually be allowed to have a view beyond a certain level, because even our suppliers actually not often are interested in showing where they're actually procuring it from. There is a privacy issue around many of these subjects. So how to deal with all of that while staying sustainable? I would think the blockchain and the crypto space could be quite a unique position to think about it, but how I'm happy to myself learn, on that one. And then going back to deep tier financing and thinking about receivable and payable, My personal example on doing tier financing has always been on the receivable side, and I'll give you a couple of examples for folks to see, where we found it successful. So one, we have done this in India, where which is part of what we call this distributor financing program. So, we have distributors, we finance those distributors, and then the distributors actually, if you think about it, sell to another set of distributors who then most likely then sell to, a retailer who then sells to a consumer. I'm talking about, let's say, devices business. So there has always been this demand that, we need to finance the distributor of the distributor, which is kind of this tier 2. And, banks have been very happy to do that as long as they can find a visibility of these goods passing through this chain. So we've been quite successful on those programs, and the banks have been very happy to actually run them, within a certain kind of metric structure of, percentages, etc. So I would say the banks should look at those models. The second place I think we have been very successful on deep tier financing is where I call it in a supply chain finance program is normally we think that, you have a big buyer at one end and then you keep going down the chain, you have smaller set of, entities. That's not always the case. Quite often you have two big large entities who are buying and selling. In the middle, there are small set of distributors or partners who are actually taking it and then converting it, to another large entity. So we have been very successful where we want to sell to a very large entity at the end of a chain, but because we'll have to pass through some set of smaller entities, we were not comfortable with the, the payment terms and the credit risk of the middle underlying entities, but with the banks and financing solution, we structured a model whereby the end customer, who's a stronger entity, the bank was comfortable taking that risk. And that again then became a very successful deep tier model. But these are not very easily scalable because it does require a certain degree of structuring. So, we look forward to how this could be done.
No, absolutely. I think that scalability point is the critical one for me, because I think we see needs driving innovation, within a company, within an industry and a sector. Things will happen because they need to happen, but actually, fundamentally, there is a mismatch of risk appetite, whether it's from private banks or from the corporate itself going into the deeper tiers. So I think, ultimately for me, it comes down to this collaboration and cooperation. Private sector isn't going to solve this on its own, for sure. So building on the work the multilaterals are doing, I think it feels there is a solution in there somewhere.
True.
But it's not easy, but it has to be doable, right?
If I can add something on top of what Raul was saying, because you said something so important to me that is in relation to the visibility that is required. The last thing that you want to have is an SCF program, a sustainable program that is without the visibility down on the road, and then you discover at the later stage that it has been classified ESG financing, and then at the end of the day, the ones that are 2 tiers down are not doing anything all right, because then it's turned to be the opposite of what was the initial goal.
And that actually talks as well to a bigger issue, I think, is there is no common standard in terms of measurement. And, we're going to hear from Mashreq in a second with an example and just some ideas as to how those things can be measured. But I think, again, that's something which as an industry we can work together to fix. Vin, are there any Q&A, conscious of time?
Yeah, actually, there's one observation that came in on the chat, and it said, great panel. Most SCF panels are so basic. This was for real, for a change. So that sounds like a good start. And then we have a general question, and then there's a question for you, Wayne. And the general one that, Wayne, you can field or whatever is, do you mean by resilience that you, and I guess it's the big anchors, make sure suppliers have financial fuel to avoid interruptions and disruptions? That's the question.
Listen, the benefit of a moderator is I can pass it to the panel. So,
yes, of course.
So resilience, the definition of resilience is that, but it goes one level below. It's not only resilience from a financial perspective, but it's also to encourage certain groups, be it, for example, I'll give you an example that there are minorities in certain parts of the world who you would want to encourage to be suppliers and come up the curve. That's resilience as well from a GE perspective.
Wonderful. That's really good. And Wayne, the other question I have, why do you say that supply chain finance or payables, I get it, it's not getting to the SMEs. You know, Anchor doing payments to Vietnam, all the beneficiaries, the suppliers are SMEs.
Yeah, so the reason I would say that is because of the $1.7 trillion trade gap.
Okay, so...
And I didn't know until this morning, actually. It was interesting when Mark said that's rejections.
Yeah.
So what is the true gap? So yeah, look, there is an unmet need globally.
Okay.
So that drove that comment.
Okay, we're very good. That's it so far. Back to you. Yeah.
Okay, so look, I mean, we're on time. Is anything else you guys wanted to add before I wrap up?
No, absolutely. No? I think one final bit here is that
he's trying to convince you guys that he lost. Because the two of us, we say it different, right?
The need to, we get every bank coming to table only talking about some SCF. But I think the point which you mentioned at the start of the conversation, to have a conversation with us to understand what do we really want and what is the problem we are really trying to address. You heard it from each of us. We all have different problems. So a vanilla solution here will not really work. So just leaving that in the thought.
Yeah. Absolutely. Very tailor-made. And we have something in common, the three of us. We have all worked in GE.
Yeah.
In different periods of time.
Okay, so look, I think in closing, the summary from me would be, I think there has to be a growth opportunity. You know, there is something there, but it's definitely quite difficult to manage, quite difficult to negotiate. It will require collaboration between multiple parties. However, I think if we hold on to the fact, you know, perfection is the enemy of progress. So I think we should, you know, continue to take smaller steps forward, recognizing actually there is a much bigger picture to solve. And that collaboration across stakeholders, I think, is the key for me. So, guys, thank you very much to the panel.
Wonderful. Can we give them a good round of applause? That was really, really on track, really, really practical. So, Wayne, you're going to stay on stage and manage the rest, if you don't mind, please. That would be great. That would be great.
I think so.
So,
hey, Victor. Am I introducing?
Yes, you're introducing. Away you go.
Victor. Yeah.
So, thanks, Vin. So, we thought as a natural follow-on to that last panel, which hope was insightful and resonated with you, we could now bring it again to some real-life examples. So, what we've got now is two case studies, may not be the right word, but you know, two examples, one from Mashrek and one from Gianluca, around the way they view the world, the way they view at solving problems, and actually using these as building blocks to actually build on some of the themes and the arguments that we just heard about. So we're going to hear from Victor first. I think you're going to...
We just need to change the slide order, yeah.
Whatever.
Yes.
Well, maybe I can
okay. All right.
do mine.
We thought it would be probably help if we explain first what it is and then you can talk about the real example. So look, thanks everybody for having us today. It was interesting that three of the guys were talking about working for GE. I felt like in a lot of my career, I've been working for GE.
4 out of 4.
I've covered GE many times and been up to headquarters in North, I always forget what it's called, out of New York City. But look, I really wanted to talk about supply chain finance and the context of ESG and how the two can be linked. So I think there was a conversation just before around, you know, supply chain finance. You know, the real question is, why is it relevant to your business? How are you using it, right? And traditionally, I think a lot of the time it's been used to help support the development of a supply chain and deliver, you know, cost-effective financing to the supply chain. And I know people were sort of having this debate around, but you know, with interest rates going up, why would it be relevant? And in the past, I've been involved in some market studies, and it's really interesting. And what you find is in lesser developed markets, the differential between the cost of finance for large players and small players is huge. So if you take China as a great example, I remember when sort of borrowing rates for SOEs were, you know, probably hovering around 3%. The equivalent cost of borrowing for working capital for suppliers out of China was around 20%. just to give you some sort of understanding of the difference. And part of the reason is that maybe China's not so much a lesser developed market anymore, but in lesser developed markets, there's less credit data, and therefore the credit arbitrage between large and small players is very wide, right? So if you look at more developed markets, Western markets typically, that differential between large and medium and small players might only be 4 or 5%. But in other markets and lesser developed, it can be 15% plus. So the real challenge is if you're trying to grow your business and you've got strategic suppliers in lesser developed markets where the costs are lower, you know, the reality is that differential is quite significant. So being able to deliver cost-effective finance to them can be very important. And it's that arbitrage essentially that, you know, supply chain finance is playing on, because it's really looking at the, you know, the credit worthiness of the buyer rather than the supplier. And that's really what it amounts to. Now, how you use it is a different question. And I've been involved in some supply chain programs where, you know, somebody was really trying to, you know, sort of grow their strategic suppliers, the reliable suppliers, the suppliers they thought were doing the right thing or could deliver what they needed for their business. And therefore, they wanted to direct more of that effective cost of working capital to them to grow them, right? To grow them. Or maybe they're just a really fast-growing company, which you tend to see in certain industries. Suppliers can't keep up with them. The suppliers lack that access to working capital. So being able to deliver that supply chain finance to them, which enables them to then meet the needs, you know, that you have. But what we're going to do now is I'm going to kind of step through supply chain finance, some basics first, and then look at how you link it to ESG. I just would like to give a sort of an initial show of hands. How many people in this room have actually set up supply chain finance programs of one sort or another? Put your hands up. So it's only about 10% of the room, which sort of indicates that probably most of you could perhaps do with a little bit of a refresher. So I'm going to step through it quite quickly. I'm not sure how this, oh, there's the button. So first of all, we'll talk a little bit about the basics of supply chain finance, then the critical success factors as it relates to sustainable supply chain finance. And I'll explain what sustainable means in a moment. We'll define sustainability. We'll look at how you measure it or could measure it, reward it, and then what you need in terms of partnering for success. And perhaps Gianluca will have some real-life examples. So this is more of not a case study, but a how-to guide. Because the issue is if I gave you a case study, you're all different anyway. So one case study may not be relevant to somebody else. But if we just step back and touch on the basics of supply chain finance, the first and most important thing is that the way these programs work in very simple terms, and they can be called supply chain finance, payables finance, reverse factoring. So one of the confusion is there's 5 different names for what we call supply chain finance. But what I'm talking about is what's known in this market as buyer-led supply chain finance. So it's anchored on the credit worthiness of the buyer, right? A strong buyer dealing with suppliers that are not as strong from a credit perspective. So typically a large organisation buying from smaller suppliers. And in these programs, it's quite simple. What happens is the buyer has got invoices, they approve the invoices, they pass those invoices to the financier and say, I would like to pay these suppliers early, and a discount or interest rate is applied to those payments. And ideally what happens is those payments are discounted at a rate which is much more cost effective than what the supplier would access in the market if they were to go and borrow the equivalent amount. And that really is, you know, it's as simple as that. Now, obviously, it's not quite as simple as that because you need systems to manage this, you need to do it in an efficient way, you need to obviously think about your suppliers and how you can tier those suppliers. You know, you may want some suppliers to get a lower cost of finance, right? The ones that you really want to grow rapidly versus perhaps ones that are more sort of in the middle of the pack or those that either don't require it or you don't feel as comfortable with. Now, the challenge in sustainable supply chain finance is how do you now tie a supply chain finance program to some measure of sustainability, right? Because what you really want to do is you want to reward people for doing the right thing, right? So whatever your sustainability objective is, you want to encourage them to do that thing and then reward them with a cheaper form of finance that will encourage them to do the right thing, essentially. And the idea is that you can differentiate that pricing based on, you know, what sort of levels of sustainability they're achieving. Does that make sense so far? So I'll just go through a simple program. I'm not going to spend a whole lot of time on this, but if you think about the parties in a supply chain finance program, you've got the buyer on the right-hand side here, and you've got the suppliers on the far side. And really, all that happens is the bank stands in between, it agrees a program with the buyer, and that basically those suppliers send in invoices to the buyer approves the invoices, they send a file of those invoices to the bank, and the bank then applies the appropriate discount factor or interest rate and pays the suppliers early. And you need a system to do that. So typically banks will have a system that will do that processing and that heavy lifting for you. But of course you also need to onboard those suppliers, right? Because being banks, you know, anybody that we want to pay has to go through some sort of KYC process, right? So there is a supplier onboarding process, and quite often there's a selection process, right? Working together, we determine who is going to participate in the program or who we would like to offer the program to, and we may then tier those suppliers depending on what we're trying to do with them. And what you can ultimately do is you can tier the pricing. Now, these are not necessarily good examples of the pricing, obviously with interest rates today, but essentially you would typically price that discount as some sort of base rate plus a margin. But you can vary it for different suppliers. It doesn't have to be one size fits all. And this gives you the basics then of something that you can link to sustainability. But when you think about sustainability, there's some critical success factors that you need to think about. The first thing is, what is your sustainability objective, right? And sustainability, and I'll cover this in a moment, I'll go into a bit more detail, but sustainability can mean different things to different parties depending on what you're trying to achieve. And partly it depends on where you are in the supply chain, right? If I'm the buyer and I'm closest to a consumer, particularly individuals, they will dictate what's important to them, right? Is it, you know, clothing, and they want to see that the clothing is maybe made from recycled materials or sustainable in its own right? Or am I involved in perhaps fast-moving consumer goods where there's some question marks around labour practices, for example? Or is it agriculture where there may be, people may be cutting down forests to expand, you know, the increased agricultural production? I mean, you know, sustainability is in the eyes of the beholder, and in many senses, the beholder is the final consumer of the product, right? But there can also be a regulatory perspective as well, because sometimes regulators are, you know, now specifying what sustainability means, and I'll discover that, we'll uncover that in a moment. But partly it's also about what can be practically measured, because, you know, there's many things that you might want to do in the world, but they can't all be measured. And there may be also established frameworks within a particular industry. So in some industries, there are now specified measurements of sustainability that have been agreed by all the industry players. So it's not a choice anymore. If you want to sell your product to those buyers in that industry, these are the measures, this is the scorecard you've got to produce. There's also a question of supplier buy-in, right? Because it really also comes down to how sophisticated is your supply chain. Do they understand sustainability? If you were to roll something out, are they ready for it? What are they ready for? Would you need to do it in stages, or are they in a market where these concepts are already well understood, sustainability is well understood, they're already measuring it, you're there, right? Now you're just trying to measure how good they are, as opposed to dealing with suppliers that haven't even started the journey, right? If they haven't started the journey, it's going to take longer and you're going to have to spend time with them. And that may mean that you're going to have to spend a lot of time educating them, right? Because you can roll out anything you like, but if they don't understand what it means and what they need to do to change, then it's not going to be effective. And in fact, some really good studies have been done around these sorts of programs, and what they've shown is that engagement and education actually lead to the best outcomes for ESG-linked financing programs. So that engagement, that education is important. Then you need to say, well, okay, I've got my sustainability objectives, whatever they are, what are the right metrics? How do I measure it? What am I trying to measure specifically? And can they be measured? And are they fair and reasonable, right? Because if people feel that it's not fair and reasonable, they may just resist, right? Redirect their supply to other people or cut corners or perhaps try to come up with some bogus metrics, who knows, right? So that sort of fairness and sort of engagement is important. And then you need to look at what are the processes for measurement. How often am I going to measure? How am I going to measure? Do I have the systems to measure? And there's a whole new world of sustainability metric systems coming out. And in fact, sustainability reporting, because now there are European reporting requirements in next year, 2024, mean that many companies are setting up, in addition to a chief financial officer, they now have a CSO, the chief sustainability officer, and a lot of big European companies are setting up entirely new measurement systems. Just like accounting, they're going to account for their sustainability metrics, and they're actually installing systems to do this. So hopefully that gives you the basic groundings, but now what I want to talk about is what does sustainability actually mean? Now, one definition I like, which is kind of drawn similar to the UN definition, is meeting the needs of the current generation without compromising the needs of future generations, whilst ensuring a balance between economic growth, environmental care, and social well-being, right? And that picks up the elements of ESG, but it's also balancing it with the need to still make money, right? If you lose money, you're not going to be a very sustainable business and you're not going to be developing any sustainable practices, right? So it still has to, you know, balance those needs. Where did all this come from? It essentially has all grown out of the 17 Sustainable Development Goals, or SDGs of the UN, which were adopted in 2017, and which 191 countries have now ratified. So this is not some hobby anymore. This is something that has been widely adopted across the world, and now it's being embedded in frameworks. So the most developed framework is actually the EU's taxonomy for sustainable activities. So they've created a whole taxonomy against every one of those SDGs. They've defined essentially what needs to be measured and what are the metrics, right? And that's what people are going to have to start reporting against in 2024. And in many corporates that have sort of developed good sustainability frameworks, they've now defined those same things in their own sustainability framework. So they've said, these are the things that are important to us, these are the things we're going to measure for us and for our suppliers. So it extends beyond just what you're doing yourself, but what you really want your entire ecosystem to do. And in Europe, it's very advanced. So there are companies already that if you want to sell to them, they've got their scorecard, and if you can't produce a scorecard, they're not going to buy from you. It's sort of getting to that point. But if we look at what does sustainability mean, often what you'll hear people talking about is ESG, right? So there's environmental. So we've got the things, the typical areas that are listed against environmental: climate change, pollution, biodiversity, natural resources, not exploiting natural resources to the point of exhaustion, social, human rights, diversity and inclusion, health and safety, and supporting local communities. And then governance. Now, governance is the frameworks that you put around this whole area within your own corporate environment. So how do you manage sustainability? What's your corporate structure? Do you have an independent committee or board? Do you have risk management systems that measure and track sustainability and deal with it if there's a problem? Are you on top of things like corruption and bribery? What ethical frameworks do you have in your company? So these are all elements of what is now commonly known as sustainability. Sustainability is not just environment, it's a range of different factors that touch on this concept of ESG. Now, a lot of people think of sustainability as, the impact of your supply chain on the environment, because that's, for a lot of people, they sort of sustainability equals environment, right? That's not really the case, but what I wanted to show you was just what sort of impact environmental factors come from the supply chain, right? Just so you can sort of get a feel as to the importance of supply chain. So if I look at utilities, 93% of my environmental impact is actually coming from my supply chain, which is the grey zone. If I go right to the other end, in banking, for example, very little is coming from my supply chain because I'm consuming electrons, right? I'm running accounting systems. So it depends on how you measure these things as well, because we have this concept of, particularly environment, what we call scope 1, 2, and 3. So scope 3 is really what's coming from my supply base. Scope 1 is what I'm generating. Scope 2 is what's coming from my purchase of energy, for example. So there's different ways of measuring it as well, and that will impact the way that you need to measure it. But the important thing here is to understand what's happening in your supply chain. Because if I'm looking at environmental impact in my supply chain, say agri would be a great example, right? Where you want to make sure that we're not damaging the forest, we don't have fertilizer runoff, those things. That may be relevant, right? But if I'm looking at, say, the clothing and footwear industry, it's probably going to be more oriented towards labour practices, right? Are the people working in those factories producing my garments being treated properly, right? We don't see sweat labour, exploitation, modern day slavery, those sorts of issues that you read about all the time. So it really is what is relevant to you. And if you look at, the sustainability metrics or sustainability areas, you can then look at what you're measuring. Okay, if I'm looking at climate change, what am I measuring? I should be measuring greenhouse gas emissions, right? If it's corruption and bribery, I should be looking at my policies and controls. If it's human rights, I should be looking at labour conditions. If it's diversity and inclusion, discriminatory practices. So for each of those sort of ESG objectives, there are specific areas that you can measure. And the interesting thing is a whole industry has grown out of this that will measure these things for you, right? So there are organisations that just focus on specific areas. There are some organisations that will come in and they'll go and look at, if you're in agriculture, they'll go and visit the farmers and make sure they're doing the right thing. There are others that have satellites that will look at biomass and see where the land is being cleared. There are organisations, you would not believe it, there are satellites that have gas chromatography systems that can look at a factory and they know how much carbon and other gases have been released from that factory. They can measure it from up in the sky using geolocation, drawing a box around the factory and looking at literally what that factory is releasing into the atmosphere. So there's a huge amount of data now in this area. And one of the things you have to sort of decide is, how am I going to measure this? Am I going to send a questionnaire to my suppliers and there'll be some sort of form of self-assessment and then I go out and do an occasional audit? Or am I going to send out a third-party organisation that is going to do site visits? Or am I going to use somebody that has external measures, like some of this technology, that can do it from a distance? And it depends, again, on what you're trying to measure. But virtually all these areas are now measurable. And as a result, there are organisations that have also come together that will club this data together, and you can pick which things you want measured, and it might be 5 or 6 things, and they create a scorecard. And just like a credit scorecard, they'll say, these guys are 900 out of 1,000. These guys are 600 out of 1,000. And some of these organisations have databases now running into the tens of millions of suppliers, or even more. So it's really about using data and crunching data to create these scores. So you have to think about, what am I going to measure, as we've just discussed, but how am I going to measure, and who is going to measure?
Victor, just to help you with targets.
Yes.
All right.
So just very quickly, at the end of the day, once you can measure, you then can reward. So clearly, the most relevant thing you can do for those suppliers who are doing the right thing, according to your objectives and measures, is you can assist them with lower cost working capital. So you would deliver the lowest cost working capital to those that are hitting a certain target, or perhaps you may do it on the basis of how much they've improved. You may also decide to give them more of your business, right? It doesn't have to be lower cost working capital, but I could direct more of our orders to those suppliers who are doing the right thing. I may even want to pay for products that are more sustainable, right? Certain products that consumers are willing to pay more for because they're using recycled materials, etc. You may say, well, I'm actually willing to pay more for that because I'm delivering something for my consumers, but I'm also doing the right thing by the environment. And then finally, in terms of making all this happen and partnering for success, there are different parties that you might want to engage in. So if you don't have a strong sustainability framework yourself and you need to develop this, you may want to engage a sustainability consultant to help you work through those issues. Because sometimes it can be very straightforward, you know exactly what you want, but sometimes it may not be straightforward. You may be supplying to different buyers, and even those buyers may have different scorecards. And you have to sort of, how do I'm supplying to somebody else, I have to meet their scorecards, and then I have to influence my downstream suppliers. How do I link those different things together? You will need a good supply chain finance organisation that is able to work with you on those scores so that they can load those scores into the system and say, okay, we can create, pricing tiers based on the different scores and make sure that we're rewarding the suppliers that you want to reward. You probably need a metrics provider, right? And there's a number of, you may have heard of the Sustainalytics and Coriolis's of the world that do this kind of stuff, but there are many other players that focus on particular areas as well. And then finally, if you're going to measure all this stuff and track it, you're going to need some sort of sustainability reporting system. And there are many, as I said, many systems emerging in this area. And if you're also in, for example, if your parent is in Europe, they'll be buying this thing right now because basically there's a whole industry emerging around this. But if you're supplying companies, particularly in Europe and the US, where a lot of these standards are coming in, you're going to probably have to start reporting your sustainability metrics as required by your buyer in the format they want, right? So you're going to have to think about how do I measure that? And how do I demonstrate to them, if I've got a large supply chain behind me, how do I demonstrate to them that I'm also bringing my suppliers with me on the journey? So hopefully that gives you, that's kind of a really quick sort of tour de force on how do you sort of link sort of sustainability to supply chain finance.
Brilliant. Thank you, Victor. Yeah. Really insightful. I mean, the takeaway for me from that is just this, the fact how collectively we can bring about change in terms of, the transition. By working together, we can actually bring about meaningful change. So thanks for that. Right, so Gianluca's now got an example. In fact, I'll let you describe what you're going to say.
Yeah, I'll stretch myself. Only 2 pages, first of all, so pretty quick. I would like to leave space for Q&A, and I will be also available for the coffee break later on. So it's all about reverse factoring. It's something that we started a long time ago. I repeat that our company operates in the space of agriculture. And in 2018, early 2019, we implemented the reverse factoring program in Europe. So we were one of the first UAE entity to do so out of Europe, despite it is a well-known program. And at that time, there were a significant disparity in terms of credit status with our suppliers, plenty of suppliers around, so many different payment terms applicable, and all of them, they were asking to get paid as fast as possible. Of course, we are a corporate that we are trying to harmonize the payment term as much as we can. We were growing in double-digit growth, so therefore some of the aspects were really under a lot of pressure. So we had a variety of suppliers at that stage that were suppliers with really low credit rating, so difficulties in getting financing or access to financing, literally. Suppliers with limited access to financing or with a very expensive solution proposed to them by banks or any other counterpart. And also suppliers with instead good access to credit. And this for me was the difficult part, I have to say. So let's see really the dilemma at the time that we had, because we were searching for a solution that was supporting our historical suppliers, but also to propose to new suppliers to join the program, because we were in need of product more and more, and we are talking about agricultural crops in case of grains or forage or any other different crop, because Aldara operates in the space of food security for the UAE, so we had a particular mandate to go for it. And improving the working capital ratio, of course, was also part of our goal. In which way? In a normal way. That was the extending our payment terms as much as possible. Now, we spent a lot of time and this was the most important one. Before in the panel, we say the same story. You need to spend a lot of time before going live. There is a lot of excitement. You feel yourself that you're late, but before going into this, you really need to do your homework. So we spent a lot of time over there in all the ecosystem. We met all the business counterparts, including myself, that I'm the treasurer, in listening to them, because everybody had a different request. And before identifying the significant benefits that were there, we have in parallel selected the counterpart that would be able to support in that particular journey. So a very difficult environment. We're talking about hundreds and hundreds of suppliers in Europe, in different geographies. And let's look what we did in a nutshell. So step number one, I introduced before, it is an analysis to understand where you stay, what are your supplier needs, and in order to be really effective, and you need to ask yourself, as I said before, a couple of queries at least. Am I adding value? For which part? Only me or also for them? Do they really want it? It's coming with a lot of admin job, the reverse factoring. But when you start, then it's like a train, high-speed train, right? You can stop only in certain location, not every place, unless you have a tailor-made solution. Then the second was the selection. So we have done a preliminary discussion with so many banks. This instrument is well known out of Europe and other geographies, of course. And we try to get excited the suppliers. Remember, in our case, we were talking about farmers. So the farmers are really small entities. Sometimes they have also a limited number of people in the finance department. So they really are also unable to look into certain aspects of the supply chain financing, despite we're talking about Europe, because they are farmers. I'm not saying anything bad, but you need to realize where do you stand. And then you spend significant time in selection of the banks. Why? Imagine. In our case, one of the main drivers was selecting a bank that was fitting our geography. There are many difficulties there are some banks that have a different platform by country. There are other banks instead that have the platform that can be applicable everywhere, irrespective of where you operate. And of course, we selected the second one. So a platform that is scalable, that can be applicable to entire Europe. And the institution has been selected with certain criteria. So we have done a proper evaluation, and we selected the bank, in this case, that was also a combination of quality of service as usual, the pricing, and all these things. And we selected a big counterpart that was also, in certain cases, operating with the supplier itself. Otherwise, we sit down really around the table with the three parties, and we managed to succeed in something that was a win-win strategy for everybody. What? To bring the supplier working with that bank as well. And this was really sorting out the entire ecosystem, not only at tier level 1, but also at one level farther down. The implementation was I would say, the most difficult part, simply because there were some suppliers, as I said at the beginning, that they were not interested. Why should I join your program to do much more admin job? Why? I already paid the right amount of money for the cost. I don't need money, I have. So we concentrated our effort in all the other cases where they were requesting money to be paid faster or cheaper, and we succeeded significantly. I have to say that out of the original 100% of the supplier that we reach out, we have successfully onboarded almost 80%, so 78% they joined the program, and this is a success story.
Absolutely.
But we have to realize, in our case, that some of the suppliers that initially were super happy to join the program, they became too good at a later stage due to us, that they had by themselves got access to cheap financing, and then they said, look, now I don't need it anymore. And this is another real true story. So You need to evaluate your suppliers. You don't need to squeeze them, of course. This is not what I'm saying, but they need to be happy to stay in that particular program. There should be the right incentives. In our case, the incentive was really effective because we were able to retain the suppliers for such a long term, but as I anticipated before to Wayne, I mean, this is something, one of the instruments that in our case we can use to have retention of the suppliers. We can do even much more that is out of the scope of the SCF. The maintenance is something that, again, most of the people, they don't consider. It's really very, very important. I give you an example that is affecting us out of Europe. There is a change in the regulation that applied since 2022 in the EU that is in relation to the food industry products, for which the EU has confirmed that directly or indirectly, also through the support of a reverse factoring program, the suppliers cannot be paid longer than 60 days. So it's a big change to people that were used to or able to use the supply chain financing program up to 180 days or 120. So now in EU for food products is 60 by law, and there is no way out. So is this becoming less attractive in Europe for the reverse factoring program? For sure, for that particular product, for sure. They are killing the instrument in a way because it's limited to that 60 days only. So your off-balance sheet treatment or out of your net financial position is limited only for your 60 days. Then it becomes a normal working capital facility, if you like. You still repay after 180 or 120, whatever, but it's affecting your balance sheet. This in a nutshell.
Brilliant. Thank you. And before we go to Q&A, I mean, just a couple of observations from me. I think this is a really enlightened view, actually, and I wonder, as I was listening to both the presentations, to bring about change, whether we need a sort of a mindset change from corporates to a certain extent, because the thing around client retention, corporates' responsibility is to create shareholder value, but actually, if we start thinking about supply chain finance in a different way, it might get you to a similar position to Gianluca's experience. And the other thing in a similar vein is, and I know some corporates see supply chain finance as a profit center, and actually perhaps there is some good reason to start thinking about it differently. So yeah, really interesting. Thank you both. Really good. Vin, any?
Yeah, Wayne, that was really, really wonderful. From my own point of view, I really found it great. Both presentations, workshops, or simulations are really, really, really great. And Gianluca, I've understood to a degree the resilience thing, but your story really gets it home, that this is not just about the money, it's about the resilience of your supply chain. Yeah, really, really two great presentations. Just two, I think they're questions or comments. Question from someone. My background is in traditional trade finance. Transferable letters of credit have pretty much disappeared due to compliance, KYC. Is this challenge also relevant to deep tier finance? Is there a big challenge? Is there a challenge, I guess, in the deep tier finance with compliance? Because
yeah, indeed, it could be a risk, I would say. But to be honest, I'm still using the transferable LC a lot, significantly.
Okay. Well, that's encouraging.
I don't see big challenges there. Okay. As long as you know the parties involved, of course.
Very good answer. Great. And the second one was regarding the ESG and all the reporting requirements, etc. I am all for sustainability, but surely all this reporting will have a big impact on productivity and the bottom line.
Look, it's coming. It's not a question of if, it's a question of when. Europe's already introduced the reporting standards, and companies, I can't remember what the cutoff is, it's 250 million, I can't quite recall. Germany's going to take it lower. The US it's rumoured that they will introduce their own reporting standards very soon, primarily around carbon intensity, whereas the European standards are around a broader set of metrics. Here, UAE already has reporting standards that apply to larger organisations, but it's also rumoured that the government here is going to introduce more reporting standards as we get closer to COP28. So This is the beginning. What we see now as something that's happening in a few locations will be happening across the world. And think about it. If European and US companies require reporting, the rest of the world will have to follow because the whole supply chain is largely oriented around those, supplying those two markets. And I think it's inevitable that this will, in the next 3-4 years, will sweep across the world. And a lot of people are now suggesting that ESG reporting will become just like financial reporting. It will be a requirement. Certainly, if you look at the banking industries and if you look at investors, there are now many investment funds. If you don't have ESG reporting, they won't invest in you.
Also banks.
Banks as well, right? And in Europe, more than 50% of all the financing now in Europe is sustainability linked. So the reality is that the train has left the station. It's going to pick up speed, and it won't be a question of do I have to do it. You'll have no choice unless you want to operate in a backwater of the world where nobody cares, right? But that is going to shrink. That space is going to shrink over time. And I think you see it with the fact that 191 countries have already signed up to the SDGs. It's not a minority of countries anymore. So I think, it's better to embrace it, look at how you can leverage it. But what's interesting is there's a lot of studies that also suggest that if you're more sustainable, your profitability will be greater, right? Because a lot of it is around eliminating wastage, being more energy efficient. It will drive a whole lot of efficiency and improvement in the way that people produce things, make things, use things.
But we shouldn't miss the central point as well.
Yes.
The reporting is only designed to change behaviour.
Okay.
Because depending on your view, we won't have a planet
Very
in
good.
20.
Very good.
So, it's
So,
not a bad price to pay.
Yeah, I'll just check any question from the audience we have here. Wonderful, great.
Hi. Thank you. Victor, I just want to say firstly, a very good presentation, solid gold material. You've condensed 10 months of sustainable finance studies I've done in just a matter of minutes. And Gianluca, you've mentioned the point on incentives, and that's actually the point that I'm basing my question on. How much can banks do in terms of incentive to go into sustainable supply chain finance? Is it just on the pricing element, especially with the backdrop of cost of fund, increased interest rates? Is it just cutting down 10, 20 basis points? What can be done? That's my question. Thank you.
That's a great question.
Thank you for the question. Well, first of all, I would say that the incentives for the banks, because in Europe and in other geographies, they are obliged to do that particular deals, right? Otherwise, their cost of funding is way higher. So there is an indirect incentive at their end. For the corporates, I would say, of course, the benefit in terms of pricing must be there. I see significantly benefits in a reduction of the marketing campaign when you do ESG very well, especially at our end, that we are an agricultural company. I can say that at our end we were doing these things in the past from solar and other things, but we never marketized these very well, and the beauty of ESG is coming at the right time. So the incentive in SCF instead, for me, is something that still not have been accomplished in full. What I do at my end, I'm trying to make sure that the suppliers at any level that are in our ecosystem are ready for this stage. And I can tell you that some of them are not. So the incentive, you may have the right incentive, but if they are not ready, you better wait for a better moment. This is what I've seen in few geographies.
I think it's a tale of two cities, right? It depends on where is the buyer and where is the supplier. But, if you look at a lot of the worst practices, they're happening in emerging markets, right? Because the regulations in those countries are more lax. And it just so happens that they are also the markets where the credit arbitrage and the pricing gaps are the largest and the availability of finance is the thinnest. So the reality is actually the differentials can be very, very significant when you're talking about emerging markets. And I think the reality is today, those supply chain programs may be rolled out more on the basis I need higher volumes, I want to support my more strategic suppliers. If we put an ESG switch on it or focus on ESG and we say we really want to grow those suppliers that are doing the right thing, then the differential between what they would raise their funds at and what you can deliver through supply chain finance can be very, very significant. I mean, I've run some of these programs previously. As I said, you know, you look at China where the differential's up to 15%. That's a lot to play with. And I think what will happen is that more of these programs will have to become ESG compliant because companies will want to make the change. They have to make the change, or they want to make the change, so this will become a bigger feature of supply chain programs. And I think more of these programs will become ESG linked. And I think that, you know, that the suppliers that you want to impact the most are in the markets where you've got a lot to play with. So it's not basis points, it's much bigger than that. 5%, 10%, could be as much as 15% depending on the market. That is very, very significant, I think.
And there are many cases as well where the other element which is very important is in the unit price of the product that's being sold, because that commercial negotiation often goes side by side, so it's not always so obvious in terms of that basis point incentive, because actually there's the product cost as well.
And if I can add, I mean, at the end, you said previously, this year in Dubai, there will be an important, in October or November, right, moment for all of us. So there is a lot of pressure, positive pressure in looking into this at this stage, especially in this region. And this is very good.
And I would say, by the way, that if they're a large supplier and they have access to, you know, capital markets and or finance, they're going to be under the same pressure as well, because more and more banks are now looking into sustainability. In fact, sustainability in a lot of banks now is becoming part of the KYC process. I was talking to another bank the other day and they said if the client does not have a sustainability framework, they no longer pass KYC. They won't deal with them.
Thank you. Okay, yeah. Another question over there?
Yeah. If you talk about, I mean, when you talk about sustainability in supply chain finance, as we go along, are you, as a financer of supply chain costs, are you going to insist that a ship which is used or a ship owner which is being used is acceptable from the sustainability point of view? Now, if your answer is yes, now, are your customers going to use your finance in that case? Why I'm asking this is, if you see the world fleet, yeah, you can see a kind of a distinct demarcation. You have the MERS and the MSCs and all who have called modern ships. Yeah. You've got a whole range of ships which are quite old, who may not in a short time qualify for the sustainability criteria. How are we going to tackle this problem, which we cannot find an easy solution? It's not like a truck or something which you can manufacture in, you know, short time. A ship takes a couple of years or 3 years to come out, right? So how are you going to tackle this issue? Well, thank you.
I mean, shipping's really interesting because actually I was talking to a bunkering company about 12 months ago, and they were talking about this very topic, and they were talking about the fact that they are now retooling their bunkering facilities around the world to provide lower sulfur fuel, or, you know, there's new types of fuel that is becoming available for ships, green produced fuel. There's big projects to look at hydrogen, and they were saying that already there are a number of shipping companies and or companies that insist that those ships now meet a certain minimum standard. The EU is expected to legislate on both shipping and aviation and specify what those standards should be. The world tends to follow the EU standards, and that already they perceive that over the next 10 years, the entire world of shipping will change in terms of those bunkering and fuel standards and the amount of you know, pollutants and or carbon that they can release. So again, it will affect particularly logistics. That's why you already have companies like Amazon, you know, converting all their delivery vehicles to electric, right? Because everybody knows this is coming. At some point, maybe you'll have certain regions of the world where, you know, people are still using the old fuels and they're not doing the right thing. But I think at the end of the day, the big markets that buy these products, they will be setting the standards. And it's like anything else, that will drive the change across the world. I think shipping is just a great example. There's already a lot of work going on in shipping to move to these more sustainable alternative fuels. It's happening right now.
And they're lucky because with the money that they made in the last couple of years, I would say that they can expedite way faster the change of the ships, right? The bottleneck is not there, is how much they can produce, the number of ships in the hybrid way.
But the important thing for financial markets, I think, though, for banks, investors, rating agencies, insurance, is actually recognizing the keyword transition. This doesn't happen overnight, but we should celebrate small wins as we go and recognize as long as we're making positive progress, actually, that's what we should be aiming for.
Wonderful, Wayne. I just want to make one point. There's one thing better than a small win, and that's a small Vin, and that's me, okay? So what we're going to do, could we give our panel a big round of applause? It was really, really wonderful, wonderful. And our plan now is we're going to go for a coffee break, and we're going to give you just a few minutes extra to network. The networking is so good here and have a conversation. So the plan is we'll see you back here at 4:50. So 10 minutes before 5 for our one last session, which is going to be really exciting on digitalization, the challenges. Are we moving fast enough or going slow? Yes. Oh, 4. Sorry. Yeah. 3:50. Or I'd never see you back again. Okay. Okay. I'm losing my mind. in about 3 minutes and 27 seconds. So if I keep talking, people keep coming in. So I better keep making noise, you know? So tell me, how is your day going so far? How is your day going? Oh, come on, guys, you can do better than that. How is your day going? Oh, perfect. That's really makes me happy, because great is good, but perfect is absolutely perfection. And we have viewers online from, I think it's 27 countries. Yes, 27 countries. So we're doing pretty good. And we'll give you statistics tomorrow on how many people are actually here in the room. I'll be giving you an update on tomorrow's activities a little bit later. But you know, Robert, I think we'll kick off, because I think everyone, when they hear your voice, they just won't be able to resist, and there'll be a stampede into the room. So our final panel of the day, trade formation through technology and regulation, time to speed up. Some people think it's moving pretty quickly, others think it's going too slow. Let's look at the issues. So Robert and your panel, I think you can all come on stage together, and over to you.
Thanks very much, Vic. So, and if you want to go there, Joel, if you go at the far end. That's got your name on it, Jim. Yeah, you want to sit down there. Thanks very much, all of you, for staying the course and still being with us at this late hour of the day. It's been a fantastic day so far, and we hope that you're going to enjoy and get something from the session that we've got coming up now. What I'm going to do very quickly is just ask each of the panelists here to say who they are, what they do, in less than a minute. I've already warned them that there's a time limit on this. Joel, do you want to go first?
Okay. Yes, thank you, Robert. So my name is Joel Schrevens. I have two roles at China Systems. I'm head of European operations, but I'm also Global Solutions Director for China Systems. So we are active in the space of providing software applications and services in the context of trade and supply chain finance, back office and portal solutions.
Thank you, Joel. Anna.
Hello, my name is Anna Kavtaraza. I come from Georgia. Currently, I represent the Basis Bank, management advisor in various areas, FI, trade finance, digitalization. And I'm also an independent consultant working with financial institutions on various projects related to trade finance and supply chain.
And finally, Jin. And by the way, Jin is not multitasking by doing his emails whilst he's doing the session, but don't worry. Jin, if you'd like to quickly tell everyone what you do and who you are.
I'm Sebo Jin from Beijing, China. I'm a litigator and arbitrator, but special on the trade and trade finance, especially the case like letter of credit, the money guarantee, bill of exchange, and factoring, forfeiting, like that. Thank you.
Jin's very modest because I think he's been involved in virtually every case in the Chinese courts that involves a bank guarantee, a letter of credit, or a payment instrument over the last 30 years. But we'll come back to that in just a minute. So the title of this session, as you've seen, is Trade Transformation through Regulation Technology. Is it time to speed up? And the question we're going to be asking ourselves here is, first of all, what needs to speed up, and why does it need to speed up now? Why is it time right now? And I want to very quickly paint a little bit of a picture. You haven't come here to hear me talk, but the panelists, but I just wanted to say a few words. And we've heard earlier that world trade is back with a bang after the pandemic. Trade flows are up 20% on pre-pandemic levels, which is extraordinary given the couple of years we've been through. As we heard from the panel earlier with the multilaterals, that trade's tilting towards $25 trillion a year. But there's a but, and the but is there's a problem. About 50%, or maybe a little under 50% of that is financed by some kind of bank intermediation. But there's around $2 trillion, maybe a bit more than that, which is an unmet trade finance demand gap. And the question is, why is that the case? If you think about trade finance,
It's a fantastic investment opportunity, very low default rates. On the face of it, high margins, a fantastic opportunity for people to be involved. So people should be queuing up to do that. But what's holding them back? And what's the what that needs to be sped up? Well, it's the rate, I think one would say, on how we broadcast that good news, the extent to which we can show that we've got a business which is fit for purpose, fit for 2023, and not, as we'll hear in a minute, for 1823, when most of the legislation that we rely on for some of the key areas of trade finance was actually just coming into force. So, a lot to be done. So, why now? Well, I think there are a number of reasons why now. I think one of those is obviously the alarming nature of that gap, the fact that we need to do something about it, a shrinkage in the number of banks that are actually interested in the market, and in certain parts of it, particularly the commodity trades, we see that fairly alarming shrinkage, and a lot of that is to do with the spooked nature of some of the banks after the 2019-2020 failures and frauds out in Singapore, and indeed in this region here as well. I think that's caused some people alarm. The fact that fraud is something which needs to be get a handle on. But one of the major issues is the fact that it's a business which seems to be steeped in both language, terminology, mystique, languages that we as trade insiders understand, but people in private equity houses in New York who are not financial institutions that have been involved in trade simply don't understand. Why should they be investing in something which doesn't seem to be an exchange-traded product, not easy to explain to their investor base? Those are the things we've got to think about. How do we get out to that wider market? How do we make trade as an asset class more attractive? And that's one of the reasons why digitization is key, because every shipment, every transaction with cross-border finance, with cross-border trade, involves involves an aggregate millions of pieces of paper, but many pieces of paper for transactions as small as $2,000 or as big as $200 million. They all require paper. And this is something which goes back to the time, you know, when sailing ships, rather than modern carbon-neutral ships of the future, were involved in taking goods around. The 1800s was where legislation for bills of lading, bills of exchange, promissory notes was written. So all of that and all of the inefficiencies that goes with that are issues which we have to deal with. So what I'm hoping is that we'll hear from our panel what they see as the pressing issues and how, and also, of course, the solutions. How we move the dial forward, how we speed up this business of digitizing a trade, whether that's through artificial intelligence employed in looking at documents, software, right through to the digitization of payment instruments and bills of lading. All of these things are important. We're making some real progress at the moment, by the way. In 2017, UNCTAD brought in the model law on electronic transferable records, which has been adopted in so far only a small number of countries. They do include Abu Dhabi Global Markets, locally here, Bahrain, and Singapore more recently in 2021 brought in a Melita-style piece of legislation. Importantly, though, the United Kingdom will have a new law on electronic trade documents that will become law around about June this year. And we hope that that will be a real game changer in terms of the way that people across the world look at digital trade and inspire confidence in it as a business and as an asset class. So I think that's a real point of interest. And I'll be interested to hear what the panel have to say. So enough from me. I want to come to you first, Joel, if I can. And you know, as I've just said, the reforms in the legal regulatory space, my world, are moving ahead, but they're only part of the picture. And we know that technology has been moving much, much faster than the law, as always happens. The law is the last thing to catch up. But we see, and we'd like to know from you how that's been happening. I've heard you come up with a phrase which really resonates, particularly as the way that we look at changing the law, which is what you call, I think, the lowest friction approach to achieving a wider adoption of digitalization in trade. And if you could explain to the audience here what you mean by that, the don't burn the house down approach to change, both technologically and in law, and that'd be interesting, I think.
Okay, thanks, Robert. So before I go into answer mode, I want to make clear that because we're talking about digitalization of trade, and the definition I'm using in the context of this panel is we're talking about legally authorized exchanges of digital documents, not just pushing data between portal and back office systems, because for some people that is also digitalization. No, specifically here, legally authorized exchange of documents in digital format instead of paper. So with the lowest friction approach, I think it's something quite obvious. The people who know trade, if you just look at the sheer number of participants to a trade transaction, it's enormous. It's not just the buyers and the suppliers, it's customs authorities, it's insurance companies, it's the financial organizations. So there are so many involved parties, and all those parties have systems, and they have people behind those systems. And there's decades, potentially centuries, of procedures behind the flow and the treatment of those documents. So I think it's pretty obvious, if you want to get some acceptance in the market of introducing a solution, that you have to take into account what the impact is of introducing a technology on a certain document. Because it's not a document that exists in one company, it flows potentially through 7, 8, 10, 15 organizations at once. So you have to carefully investigate the impact of touching that document, moving from paper to digital. It is possible, but you really have to look at the end-to-end flow of the document. Because a key thing for us, and we're not a startup, so when we talk to our clients about this, and they have operations running today, business continuity is a primary concern. It means if you introduce something new, make sure that it still works. So that's why also in the design, if we come up with solutions using new technology, we ensure that we can use the same functionality to process either transactions which are driven by paper flows or driven by digital flows. So that ensures the business continuity that we want to guarantee to our clients.
And it's a really interesting point, because as many people in the audience will know, the rules on which trade has been run have been the same to some extent for 200 or 300 years. We don't want to simply throw that in the trash can and have to invent something new. We want to keep the good, but make it better.
Exactly. I want to add one thing. You've hit a very important point. You mentioned MELITA. Now, the key principle of MELITA, or MELITR, is functional equivalence. And that's a very important word, because functional equivalence and low friction go hand in hand. Because the objective is that, in fact, when you change the format of a document from paper to an electronic format, it does not mean that the data on that document is going to change. It does not mean that the properties of that document, the objective of the document, are not changing. And it's also to put also the business people's mind at rest. You still need to understand the objective of those documents, how they are used by organizations, what purpose do they have. The fact that the output format changes should not impact the way that you do the business. The only thing is the speed of execution is going to change. And instead of starting from something structured, printing it out, sending it into a printer, then using some sophisticated OCR technology to pick it up again and turn it back into a data and present it on another screen, the only thing that we're doing is going screen to screen and getting the physical couriers out of the way, lower carbon footprint, but the data still flows in the same way, but more efficiently.
And we'll come back to this a little while. I want to turn to you, Anna, and I should say before, when I said that a lot of banks are stepping back from trade and commodity finance, it goes without saying that the banks that are here today obviously are not in that category, nor is Anna's bank. And you know, one of the things which, you know, we've heard earlier from, as Stephen Beck was saying, $2 trillion of trade finance gap, clearly a lot of work to be done. And I suppose the question I have for you as a banker, Anna, is what do you think that banks and their customers, because they're obviously, you know, it takes two to tango, what can they do better that they're not doing now?
Very good question. Thank you. And while listening to you, and as you may know, I'm also a member of ICC, so I was quite involved in DSI and MLETR as well. So that's a very global picture, and that's a very good step forward, but it's a long way to go in terms of the interoperability of the global trade and the countries in between. So as a banker, because I think you asked this, the question, as a banker and as a practitioner in trade finance, and also as a consultant in some countries, and I'm looking on the audience here, and I'm seeing that we're talking on a very big issues here, but the tangible thing is that most of the banks still, and I just want to ask the question, who are still, are paper-based, heavily paper-based. It doesn't mean how they're checking the documents, but the paper flow within the bank is tremendous. And first of all, I would agree with Joel that it has to start with the lower friction, but it has to have a continuity. And if the banks will analyze their own flows, how they want to position themselves in the digital era, and it's impossible to avoid that. It's something that will come, similar to ESG, which was discussed. It's something that is very close next door, but you cannot become digital unless you have the processes, procedures streamlined to be prepared to become digital. It's a different question how you're going to become digital. Are you going to implement a system yourself? Are you going to acquire? There are various interesting vendors, including China Systems, who have very good solutions to offer, but that's a different step forward. It's important, first of all, to be prepared. For what you have to do to be prepared, analyze what can be done within your institution as a customer or as a bank to eliminate paper, eliminate extra reworks and the works that are done, and somehow to maximize within your own resources, and that's to be a project to speed up the process, because trade finance is losing at some point its very important image because of being slow. Without digitalization, it's going to be even less attractive. This is something that I think trade professionals would agree. Very often the customers in certain regions, I would not say this on all the regions, but in many countries we've seen that the customers themselves are not very much eager to do a transaction, cross-border transaction by a letter of credit per se, because there is so many paper, there is their involvement and the time, which nowadays you see that the speed up has happened to business, so you had to catch up with solutions, and especially digitalization, interoperability, and the legal framework. Of course, we cannot eliminate here the legal framework, which is the most important part, because as you rightly said at the opening speech, vendors are ahead of the time. But without common practices and the legal framework, it will not work.
Yeah,
from my perspective, sorry. I would add that.
And the hugely frustrating part of this is, of course, why should it take over a week for a bill of exchange, for example, to go through the system and result in payment? Why do you need 5 days to look at a bunch of documents which you can feed into a machine and analyze within about 30 minutes?
It's really ridiculous.
Yeah.
Nowadays, it's really ridiculous.
Yeah.
But I think it will come, but there is more effort needed in order to have a global framework or the rules. So I'm looking at the Vin here, if I may add a little point, but I remember when we met first, or when Vin came as a lecturer in Georgia, he was talking about UC, LCs and payments made, cross-border payments, without any guarantees, and introducing LC business. And I remember the audience surprised. And it was a very rare product by then in the Caucasus or in certain regions, the LC to be used, because it was surprising. But then when people understood that there is the common rule and the practice behind that product, nowadays you see that the Georgia is one of the active banks of many DFI, TFP programs here, and this activeness is actually determined by the LCs issued or the trade finance instruments issued. So it was appreciated that there is an international rule behind that.
And you're preaching to the converted. The people out here already believe all that, but there's a big education program to be done by ICC and others to move people's thinking on, and then that's going to be crucial. I'm going to move on to you, Jim, now. I was double checking that according to Wikipedia, China is still only the second biggest digital economy in the world. Just in case you're going to boast a change in that today, but it leads the way, definitely, in the way that retail works and how that's financed online. We've got Alipay, WeChat Pay. You'll no doubt tell me of a couple of other ones that work as well. Yeah. But what's happening in the trade finance and supply chain area in China? I think I'd be interested to know is what are the Chinese government doing or not doing in terms of policies to champion and encourage the digitalization of trade? And for example, what's the state of affairs with the digital RMB?
Yeah, that's why yesterday I mentioned we Chinese learn hard how to play Kung Fu. We know Chinese Kung Fu, but we should also know AOC Kung Fu, demand guarantee Kung Fu, standby special animals, standby Kung Fu. But today we need to study Kung Fu, digitalization Kung Fu. Because the concept, so-called, the document of title from, as I know from the legal point, is from the common law. The common law said the bill of exchange, especially the original Ocean Bill of Lading, blank endorse is a bill of lading. A receipt is not a document of title. And a warehouse receipt is a document of title, but another document is just a paper. Because the law said, or the judge said, this kinds of documents is documents of title. This title represents the ownership of the goods, or you have the rights to claim the goods because you're holding the kinds of paper, a piece of paper. So that is presumed, by the law, or the judge said, this paper represents the title. And the title means the ownership of the goods. So it is easy for our Chinese to practice this kind of Kung Fu. We just digitalized this piece of paper in an electronic paper. That's easy. We just use some technology, to digitalize this paper in an electronic paper and added something like a signature, like a blockchain, like a thing like that. But we Chinese love to practice this kinds of Kung Fu. So that's why in China, we are going to change our law. In 2020, we have new law we call civil code. But we never have a code in your country, you call commercial code. In the United States, you have a commercial code. But in China, we just have civil code. But the standby, demand guarantee, letter of credit, bill of exchange belong to the commercial code. So we have no commercial code. What we should do? We make laws. We hope the Supreme People's Court make a new set of rules on standby, or new laws of demand guarantee, new laws of letter of credit. And in the future, we may make a law special on digitalization of the document of title.
People will want to know, will that stop things like, for example, the Qingdao metals fiasco happening again?
Yeah, the Qingdao metals, because they use the paper. They use the warehouse receipt, and they move the letter of credit, they move the paper, they move the money, but they never move the goods.
There weren't any goods. That was the problem.
That's, in China, is very popular. It's trillions of volumes of transactions like that between mainland and Hong Kong, Singapore and China, from this province to another province, from Shanghai to Beijing. And they just move the paper, because paper represented the goods. But the goods in the warehouse never moved. They move the paper, they move the money, and all the warehouse receipt is fake. It's fake warehouse receipt. They just have 100 tons of copper, oxygen copper in the warehouse. But the warehouse issue 100 piece of paper represent, every piece representative 100 tons oxygen copper.
So definitely digitalization would kill.
That's why, you know, this game played in China earlier, and I say that when the Hin Long case in Singapore, I find, oh, this story happened in Singapore. When I see the Green Hills case happened in London, oh my God, the fraudsters play the same games in London.
Yeah.
So that's why we Chinese love to digitalization, because we can use this new technology to prove these fake documents, fraud happen again.
And that's why I think everyone's going to be really interested to see where the Chinese Supreme Court goes with this, because obviously it's a huge amount of trade there that Western banks, other people are interested in, insurers, and of course they want to see that they get that right. So it's a really important. So you need to keep us updated on what's happening there.
Yeah.
Can I move? I'm going to move on because we might run out of time otherwise. Joel, getting down to the nitty-gritty of this, I mean, we've heard why there are pressing reasons why digitalization has to work. But what for you what do you see as the key sort of global mass adoption enablers in trade finance?
Yeah, that's the key question, of course, and I'll start at a high level. The key challenge in making all of this happen is alignment. And I think the smallest project or the smallest initiative fails if there is misalignment between involved parties. And misalignment leads to a mismatch of expectations, and mismatch of expectations makes things fail. So a bit more detail about the alignment, because there are several dimensions to what I consider to be the key requirements to create some substantial mass in terms of digital documents. And the first one is the obvious one. It's legal alignment. Trade is a business which is built on trust, but there needs to be more than trust, because the trust can really be there if it's backed by a legal framework where people executing that trade business are comfortable to run that business. There needs to be a system in place. What if things go wrong? So legal alignment between the jurisdictions involved, and that's why at a domestic level, it's much easier to solve such challenges. If you see successful digital projects, it's often domestic. Cross-border, you're facing a whole different set of challenges. So that's why we'll also think that to clear that obstacle, that the banks or the financial service providers will typically be data mining their trade chains and go for jurisdictions. If UK adopts it, perhaps within the Commonwealth or UK, Singapore, those things will hopefully create a domino effect. So the first one is the legal alignment that is required. The second dimension is that you need operational alignment. And that has to do, again, with that mismatch of expectations. Documents flow through many organizations. What you don't want is one party not to understand what the other party is going to do. So you need to align also your operating models, that you know what's going to happen next. What am I supposed to expect? And standards is, of course, a part of that operational alignment, that if you send let's say, a digital document in electronic format, that you understand the meaning of that data in that document. So the second level is the operational line. And then the third one, which I personally consider from a technical point of view, if there's one thing which would really open the gates, I think, for digital trade, it's for me number 3. And it is a common digital identity framework. Because how do you avoid abuse? You have to know who you're dealing with. If it's not on a piece of paper where you can start looking at stamps and all sorts of things you're familiar with, there has to be something else that gives you confidence. So a common digital identity framework, and I always, if I've got the time, I always like to make the comparison with travel. Yeah? I have this thing I can get on a Thalys. I live in Belgium. So I can take a Thalys train in Brussels station, show my passport, and have my luggage checked through from Brussels to Nanjing, where we have our development center. And I'm actually taking a train and 2 flights. And my luggage, the allegory is the comparison, is data, is checked through till its final destination. Why does that work? Because the service providers, that's where the comparison is, the service providers, the airlines, the train companies, or even other organizations, they recognize my digital identity. And they can check my luggage through. So they give me an end-to-end experience. We have to move to the same thing for trade, whereby companies collaborate. And there's a fantastic word, again, in travel, code-sharing. Code-sharing it's from the travel world, but actually it fits well the technology world as well. Service providers, tech companies have to collaborate. We're not specialized in everything. You have to let people do what they're good at. But if you can check the end user's data through different systems, whether it's compliance, whether it's a logistics system, whether an insurance system, those are all service providers. But if we move to common digital identity for companies doing trade business, that could really, I think, allow us to move to real global adoption for trade, because it becomes, there's a safe method. Trust, to be trust who you're dealing with. You have to be able to trust that.
And that's a really interesting point that you make about trust. And by the way, I love your confidence in putting your bag on a cart in a railway station and hoping it's going to turn up in Nanjing. There was a time when I went on holiday, I would always get a window seat so I could see my bag being put onto the plane, because otherwise the holiday could be completely ruined. Yeah. But look, but here we've got institutions like SWIFT who spent decades building up trust, but haven't yet, produced something which fulfills all the needs of the new digitization age. And then you've got great innovators and entrepreneurs and fintechs which have got fantastic ideas, but of course have to build that trust.
So getting into SWIFT, I live very close to SWIFT as well. I know SWIFT very well for 33 years already. I think, and I don't want to sound too negative, I think SWIFT has made a deliberate choice. I think they're actually sort of waiting till the dust clears, because there's been so much initiative, and some very good initiatives, very tactical initiatives which have really provided results, but there is also currently a little bit of chaos, I think, because the digital islands, the networks are popping up left and right, and it becomes very difficult for our clients and for the customers of the banks. Where do you put your money? The large banks maybe have the budgets maybe to bet on all those things at the same time, but the medium-sized or smaller banks, and definitely not the clients, have that possibility. So what is needed, I think, that there is at a higher level, we have to sort of make sure that, and it's very difficult to handle that one because it's commercially driven. There are companies out there who want to build that network and they've got a great story, but what about the friction? It's easy to talk great stories if you don't have to look in your back mirror. I said, we have to make sure we can do the business today. And as Anna has said, this is not going to change overnight. You have to be very realistic about this. It's going to be an extended period of transformation, and you need to be ready to handle both. So you can have a vision and you can dream. We have a vision. But we also need to be able to create value today with a vision for tomorrow and think about what digitalization can do, but also be very skeptical, be very critical about the risk of embarking on digitalization projects, that you don't, what the last thing we want to do from China's point of view, create wrong expectations with people, because people will not forget.
I agree with you, and actually one of the low-hanging fruit from, for example, the new legislation that's coming through will probably be digital negotiable instruments.
Absolutely.
Because you could, in principle, sometime after June, have a bill of exchange where everything happens in either the UK and Singapore, and that's where all the assets are, and then you could do the business, provided you've got a mechanism to move that digital instrument across.
Absolutely. The digital, the bill of lading is getting all the attention, and how would I say, it is an important document, and it has a certain power, of course, in terms of controlling that ownership, which is important, but in terms of the real potential, and I think in terms of complexity, a bill of exchange or promissory note could have, from a financial point of view, from a financing point of view, could probably have a bigger impact. And I come from Europe, and I look, for example, at this moment, what's happening in the e-invoicing space, which historically was sort of B2G, business-to-government business, but it's now booming in the business-to-business space. Yeah. And if you then think where today, let's say, if you talk about supply chain finance, approved payables, today you have systems where a buyer accepts invoice. He uploads invoices and accepts them, or there's a flow between the buyer and the supplier. The moment you have a digital instrument for that, you could actually sort of have all-term invoices where you said, okay, I accept this invoice. You could create a digital asset. You could create a digital document, a bill of exchange, which could then boost, again, a secondary market for those documents. So there is huge potential. And we don't have to come up with something new, call it something different. No, the people know today what bills of exchange and prom notes, what they can do. So why change it? The procedures are there, the accounting processes around it are there, everything on the liability management is there. Why invent something new, which has to go through a whole set of audit procedures again to come up with something new, while you're actually not doing, in fact, basically something different. You're doing the same thing.
Anna, I'm going to move on to you guys. We're running a bit out of time. I know you have spent a lot of time, you, Vin, others, myself, in building up the variations in the different ICC rules, the UCP, URDG. It's been a fantastic success story in getting trade to where it is now. And the question is, how do we move things on to reach that wider audience? And what do you see as the most urgent issues to tackle in trade finance, to reach that wider audience?
It seems an easy question, but it's not.
There are no easy questions on this panel.
First of all, there have been many professionals working very hard to make trade finance happen. I would like to start from the fact that trade has been there and will continue to be there without trade finance instruments or with trade finance instruments. It's a matter of how fast and how speedy catch up in terms of the digitalization will happen. The speed of trade has increased drastically, and we see it very easily on the e-commerce. I mean, e-commerce a couple of years ago, a decade ago, was not digital, and now when we see the statistics, it's a trade also, right? It's tremendous investment that the companies have made, the banks have made, and it's almost completely digital nowadays in many, many countries. I see that, again, common laws and common language without any misinterpretations would very much facilitate digitalization of trade, again, to come back to our point. And I think that it's very, very important not only to support the trade finance, how the banks have to treat trade finance, how the documents like bill of lading or any other very important documents of title in trade have to be treated, but also to go to the governments, and the governments have to take initiatives with the support maybe of the DFIs or any important bodies who have the authority to do so, to recommend, to support, to share the experience. And there are so many documents involved in trade. Again, it's not only about bank guarantee, and it's not only about the trade finance instruments, and it's not only about banks, and it's not about the customers. There are thousands, maybe not thousands, a bit exaggerated, but there are many documents. I'm looking on one of my colleagues, a facilitating export, and today we were discussing that even if you have a great idea, even if you have access to finance, even bank is ready to support your business, you have so many struggles in terms of the documentation that you may not be able to export or import. And it may take a hell of a time while you manage and you achieve your goals. So it's not only about financial sector, although we are talking about financial sector, but we should not exclude the other authorities that have a very significant role, and they have to become also digital, and there has to be a harmonization. They have to listen to the customers, they have to listen to the banks. So that's, again, it's not next door. It will take time, but of course, it should not be delayed. And every single step forward is an important step forward. And I very much appreciate what many institutions have done recently. Some of them have failed, to mildly say this, but I think they have left a very important footprint, how this has to go in a right way and not to the other way.
And I think it's worth just saying that in 2023, you might just assume that every country in the world has, for example, a digital signature legislation. Because most countries, I mean, during the pandemic, we wouldn't have survived without it. But it's actually not true.
No,
there are countries out there you have to deal with which don't. So, you know, we're talking about moving digitalization ahead on a level playing field so that all countries are taken along. Some people have still got to get to where we are now in order for that to work. I'm going to move on at this stage, Jin, because I'm going to get waved out by Vin very shortly. No, and he's...
Okay, we started a bit late, so keep on going. And
That's
it's very
fine.
interesting.
That's fine. The officials have given us an extra 5 minutes playing time. And thanks very much indeed. Jin, you know, I think you were promising me earlier some statistics, because people love a few statistics when they've got a panel up. And I hope you're not going to disappoint me here. But I think what I'm interested in is, in terms of the numbers for Chinese trade finance and digital adoption, have you seen evidence that China, despite the fact that, you know, on the outward, we've been looking at a slow growth down policy, that China wants to take the lead in this area? And do you think supply chain finance is really the main focus of where it's going to go?
As the observer of the business society, I find that in China, you know, 3 areas is very important in the future in my mind. The first, of course, is the very successful story about the digitalized of all the bill of exchange transactions in China. Because today it is 100% in the digitalized system and in the Shanghai bill of exchange institution. Last year, the number in 2021 is that the total volume in this market is about 107 trillion. That's all the digitalized transaction. That's very successful story. But of course, in my mind, this market have a lot of problem, like fraud, like crime, financial crime, but that's quite good story. But another area is the because the bill of exchange is based on the negotiability. But in China, we have a civil code, and the civil code said, and a receivable, especially the future receivable, can be assigned. So based on this assignability in China, we have hundreds of companies focused on to play as a stage to, transfer the receivable or payable on this stage. One of the stage, I could tell you that the total volume is last year is over 1 trillion yuan RMB, just one stage. But in China, we have 200 stages. So you can find in China, the receivable is very fast, their speed of the development is very fast. Everyone is talking about that. But some stages start to profit from this transaction.
Is there a danger that it's getting ahead of where the law and the regulation is?
No. But, because this stage, so every bank or company who are focused on receivable finance can participate in on this transaction. So they have this stage, thousands of companies, they putting their receivable to transfer from this stage. And the bank, if you have the credit, and you can participate on this stage. So that is very fast, and the volume in China is is huge, and it will be bigger than in the future. And another very developed area is the e-RMB, or e-Chinese yuan. And today we can use soft pocket and hard pocket. You can pay or receive money in the WeChat, Alipay, and and Jingdong.com. You can buy and sell everything, and you can buy a ticket in the communication, in the transport from one city to another city, especially from Shenzhen to Hong Kong and Hong Kong to Shenzhen, and you can pay tax. Use e-RMB to pay tax, pay your mortgage, and you can, today, more and more, because our central government is play these games very, very carefully, because this is digital currency. And our Chinese central government, they want to use e-currency, e-RMB in international trade. I have found one port in Zhejiang province, the Zhejiang province. This port is focused on oil industry, and they use the e-RMB to pay the fee or the cost happened in this port. But this is a huge industry, and e-RMB today will play the key roles in not on our daily life, but also our international trade. That is, I think, when you're dealing with China, you should pay more attention on these three areas.
Of course, it's very smart from a currency foreign exchange control position, of course, to make sure that everything happens electronically, so you can see the advantages at a government level of pushing that forward. I think we're getting down to where we probably ought to take some of Vin's remote questions. Hopefully a couple of people have managed to come up with something. Anna's going to add something, though.
Can I add something from the previous panel, which was a very interesting panel on ESG and sustainability? So I don't think there should be any motivation listed here for digitalization. It's obvious that the next steps and very short steps are the digitalization. But we saw that even sustainability, ESG, is requiring digitalization. It can just simply not happen. Yes, we're talking about different type of digitalization here, but this is an ecosystem which has to happen, and it has to happen very soon. Otherwise, even the reporting for the ESG and the green and sustainability, just impossible.
I agree, and I think the opportunities in terms of both traceability for sustainability purposes and origin, if you're talking about customs, I know that the UK and Singapore governments are looking at this as a project right now, given that they'll have an opportunity to have their own unique digital corridor. But I agree with you. I think this is a fantastic opportunity. But Vin,
just one, no questions, but one comment is, of course, e-commerce is booming. With e-commerce, goods are ordered, goods are shipped, goods are paid for smaller amounts, but it's 100% digital. Someone else made a comment that supply chain finance is predominantly digital already. And just my own comment is that you mentioned me and Georgia, and I went to Georgia many years ago, and I was telling the long time ago, you know, you can order these goods from Europe, US, whatever, and you don't need to pay any money. And they said, this sounds like a very good idea. And I said, you don't need to pay any money yet. But the way it works is on a system of letters of credit. And letters of credit, LC is issued, the goods are shipped, you all know, okay? But at the same time, it was based, as you said, under a set of rules. But in fact, there was no law governing letters of credit in Georgia then. There is still no law on letters of credit now, okay? So underpinning law, in my opinion, see, we have different opinions. Underpinning law is really important going forward. But, you know, you can do the transactions if you're in a system that people trust and they understand. And of course, there needs to be consequences. So a bank issues letter of credit in Georgia. There's no law really saying how it's going to operate. But if you don't pay, you're not going to get another letter of credit confirmed by a foreign bank. So if there are consequences. The next thing, just a few comments, that someone mentioned to me recently that they have a fintech that now can do a digital letter of credit. And I said, that sounds great. And I said, what's a digital letter of credit? And they said, it's issued electronically, okay? I said, that's wonderful, okay? And, but you know what? You know what? A SWIFT letter of credit is an electronic letter of credit. So even China systems, you know, what matters is the technology works. 25 years ago in China systems, that's a long time ago. It's a quarter of a century ago. A customer could apply for a letter of credit electronically, okay? And that was a piece of paper I used to hate working in a bank. The LC application, a document that was in 4 pages, and we had this carbon copy on it, and I used to get more carbon on me than in the document, okay? So this document was digitalized 25 years ago, but we didn't call it digitalization. You just come up with a technology. The application form was electronic from applicant to issuing bank and issued. So that letter of credit, maybe even then, but now I know, in not just China systems, but many providers, it can be applied for remotely, you know, 1,000 kilometers from the bank and issued in less than 30 minutes. To the far side of the world, because the letter of credit is electronic. And this gentleman, he's not here, but he was here earlier, he said, oh, if that was our technology on blockchain, we would have it issued in 3 seconds. And I said, well, makes no difference. If a beneficiary is to receive a letter of credit and prepare his goods and ship his goods, it's good that I can get it in half an hour, Joel, but if he gets it in 3 seconds, it makes no difference. So we got to consider the value added of the technology we're actually providing. And we had some failures in this business recently, but in my opinion, what they were proposing made no sense then, in the middle, or at the end. So for me, you know, different opinions. I think the law, I think it's great. I think the MLETR is great. But I think it's evolving what we're doing now and not trying to reinvent the wheel. Because no matter what you do, we're going to have a buyer. I'm oversimplifying. We're going to have a buyer. We're going to have a seller. Someone's going to have to prepare the goods. The goods are going to have to be shipped. Even though, KP, the ships are getting faster, you know, they're not getting that fast. You know, and 1 month voyage from Europe to Singapore, even in 10 years, is going to take 3 weeks. You know, I'm no expert in shipping. So we need to stick with the parameters. We need to remodel what we do. We need to build in efficiency, and then I think use the technology to do the messaging. I'm going to finish a final comment. I saw another demo of someone doing a blockchain system. I won't go into detail, but the letter of credit was issued in blockchain. Okay, so there's an issuing bank, and they sent it to another bank, and the bank then sent it to the, let's say, the advising bank. So the letter of credit was issued on the blockchain. And it was, actually, okay? It was. So I said, congratulations. Yeah, they said, this is a digital letter of credit. I said, it's a message. You're passing data from one party to the other. It's just that it happens to be a letter of credit subject to a specific book of rules called UCP. So I said, congratulations, but you found a new messaging system. But that's all it was. It's nothing else. It's just a messaging system. Now, I know some of you disagree with me, but that's what's so good about this event, is that we agree, we disagree, and we have a little bit of fun while we're doing it. So, any question from the audience? I'm sure there must be one or two. Wonderful.
Or disagreement.
Or disagreement. Yes, welcome.
You're allowed to disagree with Vin. That's permitted as well.
No disagreement. I was just wondering about China. And so, you know, in China, I found when I tried to do some digital solutions there, some very unique things. Like, for example, you have this company chop, you know, which is so hard to kind of get away with. It's seemingly like a culture. So I sometimes wonder, how would you actually do digitization in China, where the company chop seems to be a manual seal needed for every transaction.
Company chop as in stamp. Stamp, red stamp.
But has the company chop been changed to a digital one that's universally accepted under Chinese law now?
I must say that we just have the law called the law of signature passed by our People's Congress. But for another things, even for the digitalize of the bill of exchange, People's Congress doesn't have law. But the People's Bank of China, they play the key rules because they issued a document. This document is not a law because this is just the regulation published by the People's Bank of China said we are going to put in all the bill of exchange transactions in Shanghai in this institution. No law, but they done. Of course, the mechanism design, the term and conditions of the main contract, main agreement if the market is not so good because it's poor, you know, it's not drafted by professional lawyer, but they done, and operation quite good, but they have the shortage in the past 10 years. You know, the China, you know, if we can improve our business efficiency, can save money, you know, we will done. Even we call it is a widely growing. Widely growing means the industry growing fast without any regulations. No laws, no regulations is good because no regulator supervises you, and you can drafting a car in the speed as you like, as fast as you like.
Well, just to say, my own experience is that People's Bank of China regulation is as strong as law, or maybe tougher. Okay.
I was just going to, before you say, I was simply going to say that it's a bit like the Bank of England being able to make the laws that work in the UK. Having said that, there are probably lots of people in the UK right now who would say they make a much better job of it than the government. But anyway, let's go to Sushi.
Okay, talking about the rubber stamp or the job, actually it's not rubber stamp. Actually, in China, in Chinese called 公章. Just what the question is 公章. But in actual fact, I would say for example, LC issued MT700. Do you see the LC issued by the Chinese bank with the stamp there? No. Is it valid? Is it binding? Yes. So I believe it is not an important issue. You get what I mean? When you say you cannot recognize, you will not accept the so-called electronic documents as a legal documents, then in that case, MT700 is not acceptable. You get what I mean? So it's not an issue. Okay? This is my comments.
Thanks a lot. That's really helpful.
Wonderful. Any more questions? Any comments? Yeah, and the gentleman here. Yeah, thank you. Really, everyone is here. There's a big crowd here, so this is really interesting. You're doing a wonderful job.
It's kind of not on the job. So what I would like to know, since we touched base a little bit on the letter of credits, there are a lot of suppliers who are in UAE need kind of a confirmation on a letter of credits issued by Chinese bank. But generally what we see a kind of a trend is there is a pushback as an industry from China saying that they don't allow other banks to add confirmation to their letter of credits. Is there any regulation behind this kind of issue, or is it a general practice followed there?
Please.
Yeah, you raise a very good question because I experienced that because as a Singaporean. I remember many years ago, I do trade marketing. I went to China, talked to the correspondent bank. I said, your LC issue, we can add confirmation. He looked at me. You know, the manager, the FI, look at me. Our LC is not required to be confirmed because we are bigger than you. This is the reason, all right?
But I can add it one.
Please.
Just one point. In China, even we doesn't have the specific law passed by the People's Congress, but the judge, the court in Shanghai, they recognize the electronic warehouse receipt as a valid document of title. And at the same time, as I just mentioned, the electronic digital bill of exchange have been, the judge said this is valid. So I think the same position is like that the e-bill of lading is invalid. If the case going to the court, the judge will not surprised because this is, the same. Even it doesn't have a statute law passed by the People's Congress. That's the Chinese legal practice.
That sounds an exciting time to be a lawyer in China right now.
Yeah.
For the sounds
and actually, you're all familiar with the UCP, but actually in China, there is a super law for letters of credit. It's absolutely fantastic. And in this book, you'll find the UCP. And in this book, you'll also find the Chinese law for letters of credit, which is a really excellent law. Excellent Chinese Kung Fu law, no doubt about it, for letters of credit. And tomorrow, and also, Robert, the MLETR is in this rule book as well. So all the rules are here. So tomorrow afternoon, we'll be having a prize draw. I'll tell you about it tomorrow morning, and then we'll continue. Could I tell a little story about experience in China? Could you bear with me for 3 minutes? Yeah, because it's not about letters of credit, but is that okay? I don't want to waste your time. Okay. Well, my experience of technology in China, I have one experience I'll never forget. And the end of the story is a good story about China, but in the middle, it might not sound so good. But I was with Mr. Jin and Dr. So, and later with Anna at a ICC China Annual Trade Finance Conference. And I've been going there for many, many years, and I've co-chaired 10 of them with someone from Bank of China. So it was very interesting. A few years ago, we used to always wear headsets, the translation headsets, So when you'd look out into the audience of 2,000 people, it was like 2,000 pilots are sitting in the audience. Everyone is wearing headsets, And you talk and you discuss, and everything is translated. There's an interpreter in a little box at the back, all know, okay. So then, Jin is smiling because he knows this story. So then a few years ago, before COVID, we go for another conference. And when we arrive, ICC China, very welcome, etc., Mr. O'Brien. And then they said, we are using artificial intelligence to interpret everything. I said, really? Now, I didn't know much about artificial intelligence then, and I still don't. But I said, really? And they said, artificial intelligence. Okay, I said, wonderful, okay. So then the next day at the conference, we go in, and again, it's a few thousand people, and we're sitting here, and, the very big officials from, I think, Bank of China, ICBC, Agricultural Bank of China, make the introductory remarks, remember? Okay, and over here on the left, there's a huge screen, probably as big as this one, and over there on the right, there's another screen, probably as big as this one, and I'm really wondering, how is this artificial intelligence going to work? So first of all, one of the dignitaries got up, a Chinese gentleman, he got up and he spoke in Chinese, and on the screen, the Chinese writing in red, I don't know why, but it was in red, it appears on the screen, and as he spoke, the English appeared underneath. Fantastic. Really? So the AI was learning, okay? So, and the same on the other side, the Chinese writing as he spoke, and then the English underneath. And I said, this is fantastic. And then everyone, no headset, but everyone clapping because they could read. Fantastic, okay? So then the second dignitary got up, okay? And the third one, and it was fantastic. But then I got up, okay? And this is about how they develop technology in China from my experience, okay? I hope he doesn't use Chinese Kung Fu me after this. But anyway, okay? So I got up to speak, and I'm kind of a little bit surprised, And I said, good morning. And it goes, and good morning. Wow, fantastic. I'm very happy to be here with you today. And then, fantastic, okay? And I said, I am a trade finance specialist and I come from Ireland. And what came up was the screen was, I am a strong tiger and I come from Thailand. Honestly, I am a strong tiger and I come from Thailand, okay? But the funny thing is, Mr. Jinden at the coffee break, I said, did you see what it said? He said, yes, but you are a strong tiger, okay? So, but the funny thing is, we came back, and the next time you were there, Anna, not the first time, but you were the next time, and we come back, and again, we go through the same thing, and now I'm very stressed, okay? Because I don't know what I'm going to be this time, okay? You know, you're a strong tiger one year, who knows what you'll be the next year, you know? So, Chinese dignitary, everything perfect, and then I got up, and I'm really, really nervous, but when I did my introduction, everything perfect, and all day long, not one mistake. So that is my experience with Chinese technology. You will use technology, and this is a compliment. You will use technology while it's still a little bit rough at the edges, but then you fix it, you change it, you amend it, and then all of a sudden you have a world-beating product. I think that's what China Systems has done as well, because you have a world-beating product. So with that, I have some logistical remarks unless there's any final question. There isn't. Here's the plan. We're leaving now. We were planning to be out the door at 5 o'clock, and it is 1 minute to 5, so Vin O'Brien on time, every time, okay? So tomorrow morning we're starting at 9, and we have a really good program for you. Many of our speakers today spoke about inclusiveness and the gender balance. Tomorrow, our first session for half an hour is Women Champions in Trade, and some of them are in the room here right now. After that, we have our Trade Tech Transformation Challenge, where we have 4 trade tech companies who believe they really have something to offer in solving problems in digitalization. They will be competing for the ICC UAE competition. Then we have a really insightful, he's an economist, a business guru, and he's giving us a short presentation on the business outlook, or he's calling it right now the business lookout, okay? Which I think is kind of interesting. And after we have the business outlook or lookout, honestly, we have an amazing speaker on compliance, sanctions, and KYC. He's really amazing. And his presentation is on the shifting sands of compliance. We then go to lunch, and after lunch we come back, and we have a panel looking at sustainability again, and we have 1 or 2 local case studies being presented on sustainability and trade finance. And then we have a coffee break. You're happy when I said we have a coffee break. Okay, sounded too intense. We have a coffee break, but then after the coffee break, working with the Institute of Chartered Shipbrokers, you know, we're talking about fighting financial crime and using intelligence, artificial intelligence, but this will be natural intelligence, because tomorrow we have Michael Howlett, who's director of the ICC Commercial Crime Bureau. He's been involved in so many cases, investigating fraud, reporting on fraud, giving advice on how to avoid fraud on trade, and that is the grand finale and highlight with the Institute of Chartered Shipbrokers. And then, of course, we all go for dinner. Smiling again, okay? We all go for dinner then in the Park Hyatt. I think it's at 7 o'clock, Habib, 7? Yeah, 7 o'clock. We probably have buses at 6 o'clock, 6:30, 6:45 or something tomorrow. So all I'll say to you is thank you so much. Can we give our last panel a great round of applause?
Thank you very much to my great panel, Joel Shrevens, Anna Karavatsi, and Jinsai Bo.
Absolutely brilliant. Thank you very, very much. Wonderful. So see you tomorrow, 9 o'clock sharp, yeah? Or else you have Irish Kung Fu.